Good morning. Let's hear a robust good morning. We're here. It's industrial. Industrial. An industry that has had no ill effect compared to the brokers in the office or the retail market. If you're here for that conference, that's in another room. So we are very, very excited to host the 18th annual, 18 years. Carl, I think you were here at our first one 18 years ago. So you've seen the evolution, the change in this industry. We have, is this on? Working? We have about, my name is Ernie Aboud. I'm with Real Estate Journals, and we are very excited to be hosting this event today. My staff, myself and staff, Mark Menzies, Alyssa Galinsky, Frank Biondo, Marianne Gerson, John Mickey. We're all very proud and very, very delighted that everyone could make it today, live in person and virtually. We have about 112 or so registered live in person, and we have about 225 virtually. So welcome everyone. No question about it. We are in store for what will be a very informative morning. All of our speakers are live this morning. So we, during the 18 years, no one ever imagined what we all went through the past 12, 14 months. Lives have been turned upside down. Industries have been turned upside down. I mentioned the ill effects of the office and the retail sector, but no question about industrial has held its own and is absolutely fundamentally strong, probably stronger now than ever before. JLL recently reported e-commerce. E-commerce represents about half of JLL's leasing activity. That's up from 36% prior to or pre-COVID. I've read reports that the e-commerce industry will be a $900 billion industry in about 5 years. That's going to need about 1 billion square feet of industrial space. How much of that translates to Chicago? I don't know. Our experts up here might be able to touch on that. But fundamentally, this industry is extremely robust right now. So we are very delighted to see, for myself personally, see several new faces, old faces, as we all get together again and start to network as we all are more confident getting out there. Timing couldn't be better for this to address the state of the market. As I said, we have some great speakers today. Look forward to their insightful comments. We have exhibitors lined up here. Interact with them. We have a variety of subcontractors, engineering groups, associations. So feel free to interact with them. I know that Clark Johnson with Finishing Chicago is giving away a JBL Bluetooth speaker. So stop by and say hello to Finishing Chicago and Clark and find out what they do. But I'd be remiss if I didn't give a special thanks to our sponsors. I'm going to mention them. There's quite a few of them. So we are forever grateful to our sponsors to closely work with them. Before I turn it over to Adam Marshall, I'm going to mention our sponsors that have been an integral part of this program to support it. Bridge Industrial, which formerly is Bridge Development. They just came out. New company name, Bridge Industrial. Sparrowhawk, Centerpoint, Venture One, Whipfly, Marcus and Millichap, Northwest Indiana Forum, NIPSCO, Lake County Indiana Economic Alliance, Clarius Partners, Hillco Redevelopment Partners, O'Keefe, Lyons and Hines, Kirkland and Ellis, the Misner Group, Ryan Companies, Meridian Design Build, Peak Construction, Arco Murray, Powering Chicago, FCL Builders, Alston Construction, Morgan Harbor Construction, Finishing Chicago, International Union of Bricklayers and Allied Craft Workers, International Masonry Institute, Cawley Chicago, SIR Chicago Chapter, Manhard Consulting, FB Moran Fire Protection, Allegiant Fire Protection, Village of Romeoville, I-39 Logistics Corridor Association, SVN Chicago Industrial, Strata, Jacob and Hefner Associates, Pioneer Engineer and Environmental Services, the Daniger Group, and MJ Asphalt. Let's give a round of applause for these sponsors. Thank you. Thank you very much. appreciate that. We appreciate working with you to be a key partner and fulfill your market share objectives. So with that, I'm going to turn over to Adam Marshall. Adam, Senior Managing Director for Newmark, Chicago office. And he's going to be our keynote, and I'm sure enlighten us with some excellent commentary on the state of the market. Thank you.
Well, good morning, everyone. I'm Adam Marshall with Newmark, and I currently serve as the 2021 president of the SAOR Chicago chapter. And on behalf of the SAOR Chicago chapter, it's great to be with you here this morning for the 18th annual CIP Industrial Summit. And there's no doubt about it, the Chicago industrial sector is booming. We view this event as the preeminent industrial event of the year, and I'm so pleased to be here in person with all of you. I look forward to participating and swapping insights with all of you this morning. But first, let me tell you a little bit about SAOR, which is the Society of Industrial and Office Realtors. We're a network of global brokers who have earned the designation that requires the highest standards of excellence in commercial real estate. We share a commitment to excellence, ethics, and a constant pursuit of knowledge. The value that SAORs provide to our clients is more important now than ever before. Here in Chicago, our members and sponsors are the top deal makers in both office and industrial real estate transactions. We are a group of more than 170 brokers and 25 platinum sponsors. When you join SAOR, you become part of an elite group of brokerage professionals that invest time in building trust and respect amongst one another, and you have a designation instantly recognized by developers, owners, occupiers, and investors. So let's talk about the Metro Chicago industrial market. COVID-19 and the resulting pandemic changed the way that we all behave and positively impacted the industrial real estate sector in both manufacturing and distribution. At the end of the first quarter of 2021, the overall Metro Chicago industrial vacancy rate was at 6.2%, which is a near decade low, and industrial net absorption was 5.7 million square feet. So demand has clearly returned to pre-pandemic levels. Now let's look at the market by the numbers. There's currently over 20 million square feet of industrial buildings under construction in Metro Chicago, which represents one of the highest amounts of new construction of all time. And over the last 5 years, 115 million square feet of new industrial construction has delivered, with approximately 60% of it being speculative and 40% being build-to-suit. The average size for new construction is approximately 275,000 square feet. And industrial investment sales were down 72% in total sales volume at the start of 21 compared to the first quarter of 2020. However, this trend will definitely reverse as the industrial asset class remains red hot with tons of investor demand. Retailers and consumer goods accounted for approximately 25% of total square footage leased in the first quarter of 2021. And Amazon continues to be a dominant force both locally and nationally. They currently have 56 properties that they either occupy or are currently under construction, totaling approximately 25 million square feet in Metro Chicago. SAOR brokers complete some of the biggest deals in the market, including the following first quarter 2021 transactions between some of our SAOR Chicago members. Jason West and Sean Henrik of Cushman & Wakefield represented Performance Food Group in a 284,000 square foot lease at 115 Crossroads Parkway in Bolingbrook. The landlord Nuveen was represented by Tom Condon of Lee & Associates. Jason West and Sean Henrik also represented a large undisclosed e-commerce distributor in a 144,000 square foot lease at the North Avenue Commerce Center in Winfield. The landlord, Connor Commercial, was represented by John Cash of NAI Hiffman. Jack Rosenberg of Colliers represented Lawson Products in a 306,000 square foot lease at 8801 47th Street in McCook. And the landlord, Centerpoint, was represented by Stephen Tick of Colliers. Lynn Reich of Colliers represented B&G Foods in a 407,000 square foot lease at 500 South Pinnacle in Romeoville. And the landlord, Prologis, was represented by Jim Estes of Colliers and Jason West of Cushman. And finally, Jeff Janda of Lee & Associates represented Platinum Converting and a 207,000 square foot sale of 1560 West Stearns Road in Bartlett. And I represented the seller logistics property company. So I'd like to leave you with just a few thoughts about the SAR network. If you're an office or industrial broker, we invite you to reach out to us to explore joining. Being an SAR has been great for me, and it can be for you too. If you're a property owner, let me leave you with a few thoughts about hiring SARs. Hiring an SAR provides access to a global broker network of more than 3,200 industry leaders who are held to the highest standards of completing an exhaustive curriculum that ensures expertise, prestige, knowledge, innovation, and trust. It also provides vast coverage spanning global markets in 685 cities and 36 countries. 2020 brought plenty of challenges as well as opportunities. And 2021 so far is showing us the continued potential of the industrial sector as a key market to rebound from the impacts of the COVID-19 pandemic. So thank you all for joining us here today, and I hope you enjoy the 18th annual CIP Industrial Summit.
Let's transition to the first panel, State of the Market. And I am assuming they're all here.
Okay, hi everybody. Super excited to be here live. I had to dust off the non-sweatpant drawer of my closet, but good to be here. So it's really exciting. We have an outstanding panel to talk about the state of Chicagoland industrial real estate market. I think it's fair to say the state of the market is strong. My name's Josh Hanna. I'm a partner at the law firm of Kirkland & Ellis. Largest law firm in the world, headquartered here in Chicago with a full service national real estate practice. I'd like to have our panelists go through and give a quick introduction. Tell us a little about what you will miss as we transition from the quarantine state to something resembling normal.
Is this on?
It's on.
Is on. Beverly Hayes, SVN, commercial in Chicago. I am really going to miss my parking spot because nobody came to the office, so I always got a spot. I'm going to miss that.
Brian McKiernan with Centerpoint Properties. I manage the development throughout the Midwest for Centerpoint. I think I'm excited for the good stuff that we got out of COVID and then sort of a transition back to somewhat normal like this event. So sure.
Good morning, everyone. Jim Staton. I'm Interim Secretary of Commerce for the state of Indiana. My day job with the state is Senior Vice President and Chief Business Development Officer for the Indiana Economic Development Corporation. So I oversee our domestic and international business development teams. Yeah, I don't think I'm going to miss anything about the past year or so. It's been quite the roller coaster, but IEDC pivoted early in the pandemic to become the state's procurement office for PPE. So I don't think I'll miss the 11 and 12 o'clock at night phone calls to Japan, China, Korea, trying to secure that. So.
Thank you for doing it.
Ren Esserk, Chief Operating Officer of G&D Industrial, a newly formed platform headquartered actually in Dallas. It's really hard to miss anything other than the lack of traffic.
Adam Moore, Senior Regional Director with First Industrial Realty Trust. I oversee our business in Illinois, Wisconsin, and surrounding states. And I think the thing I'm going to miss most about COVID is my office mate, Golden Retriever.
Okay, thanks, everybody. So obviously it's been we entered the pandemic with an extremely hot industrial market. I think it's fair to say the position of the asset class has strengthened. Beverly, maybe start with you to, tell us, tell us about the impact of COVID. Obviously it was going gangbusters at the outbreak. What's kind of changed or accelerated as a result of that?
It pulled a couple of my deals forward. I had a couple of owners I was talking to and they were petrified because we were talking to them about listing Rise. This whole thing began and they both said, geez, Louise, we don't know where we're going to be in a month, much less a year. Get this thing sold. And when I sold everything I had last year, but it helped. I think it just expedited what was already in the works. But these guys were very worried about what was happening down the road. And so to minimize chances, we just put them out there and got them sold. I think a much faster time frame.
Right. There was certainly a lot of trepidation early on. Are deals that are under contract going to go forward? Are there outs in this? Are people going to, are tenants going to continue to pay rent? That kind of settled in after a few months. And then, I think, what other market forces have you seen taking hold? Obviously, retailers have been closed, which just brings forward the dominance of Amazon, the e-commerce state. So anyone else care to speak about what you've seen in that? Renee?
Yeah, sure. I mean, I think you put it well. On the industrial side, the fear was very short-lived, right? When we were trying to buy buildings in the middle of COVID, which is pretty much exactly a year ago, right? At the start of it, I mean, everyone was talking, oh, is there going to be a COVID discount? There's going to be a COVID discount. The COVID discount lasted about 5 days.
Right.
And the discount was that you just didn't go to the 7th best and final round. But very quickly, people realized that however devastating this is for a lot of families and the country, for industrial real estate and e-commerce, this has accelerated. I mean, we heard the statistic, 50% of leasing activity is e-commerce. I mean, you almost have to start thinking about how long is that sustainable, right? 50% of the economy is not e-commerce. So it's been really, really good, and everybody has noticed, and everybody wants to play in this sandbox. It's starting to feel like a small sandbox now.
I think, there's a lot of, especially for the industrial market, a lot of positives that have come out of COVID. But I think there's been a couple of negatives too that maybe get passed over. And one of those is construction pricing. Steel prices are up significantly just since the end of last year, and that's all due to the mills shutting down for COVID, and then the increased demand coming out. One of the other issues we've seen during COVID is the entitlement process, just with municipalities closed down, where you'd normally kind of show up at the town hall with a box of donuts and talk to the development director and the economic development person and possibly even the mayor, kind of get all their feedback. You can't do that anymore. So that's really kind of changed things on the development side.
You're welcome to come to Indiana. We're open.
Glazed or chocolate?
Okay, well, so good news continues. Vaccines are increasing. Things are beginning to open up. The economy is picking up across different sectors. People are starting to move back into the office. So how is that going to impact things moving forward? So Adam, I'll stay with you. And what does back to the office look like for your firm? And how do you see the market being impacted in this next transitional phase as people kind of slowly move back in and eventually we get back to normal life?
Back to the office, I think, is slowly evolving, and like probably a lot of people in the room, we're not exactly sure what that looks like as far as the time frame goes. Our firm is has done very well with interacting with each other and collaboratively through COVID, and we've all learned how to work very efficiently electronically, and I think there's a lot of pluses to that. There's also a lot of pluses to those water cooler type conversations. So we are slowly getting back to in the office. It's all volunteer at this point, but on a daily basis there seem to be more and more lights on in the office, more and more people showing up. So I think it's going to be a slow evolution. As far as how it impacts our industry, I think again, on the industrial side, I think we're going to be on the positive side of things, but I think we're going to see more companies trying to put office space into their industrial facilities because it is a much more limited environment. They can control everybody in the building, not just the people in their suite. They have more space to spread out. We had a number of tenants that built, not even built, but just set up impromptu conference areas in their warehouse over COVID. And you'd walk through the warehouse and there'd be a giant table with 10 seats around it or whatever, so people could socially distance and still have meetings. So I think some of that on the industrial side, from a nuts and bolts standpoint, I think we're going to see people asking for more office build outs going forward.
And Brian, what is CenterPoint's?
I think, from running the business day to day, I really don't think it's going back to office as an event. I mean, I think we've done, I think part of the office would say people are doing better, kind of, now liberated from the office. I think the interesting thing is going to be the younger group that, I think needs the apprenticeship type concept, meeting with people. I think the events like this, networking. So I think that's probably the thing that consciously we're thinking about, is that we can run the business as well or better virtually, so to speak. Especially because I think asset management firms not just scale, so you're deploying more and more capital with less and less people and doing it nationally. But I think it's really, I think everybody in the industrial space is trying to recruit talent, and that how do you get the younger people in? How do you get them to build their networks? How do you get them to get the repetitions, understand sort of the investment thinking and logic? And so I think that's really what we're wrestling with.
Okay. So other big news, we have a new administration that's pushing mega packages towards COVID relief, infrastructure, both non-traditional and traditional. So, Jim, this is something I'm sure you're very focused on. Tell us a bit about the opportunities and challenges that these proposals provide to your department.
Well, it's great. Indiana came out of the pandemic, or is coming out of the pandemic, fiscally stronger than we went in. We went in with a $2.4 billion surplus. We spent down about $500 million of that for PPE and other emergency-related spending. And then the first 3 months of this year, we erased that deficit. Our revenue projection has us going about $2 billion higher. And that's not including the money that's flowing out of Washington right now. So our biggest challenge is figuring out what to do with these lottery winnings, so to speak, and how to best channel those into long-term investments. Where the opportunity is that the same thing is that we now have a chance to do an investment in Indiana. We're going to spend about $500 million on a regional economic acceleration program where we're going to give at least 10 regions in Indiana up to $50 million. Hopefully they can leverage $250 million or more within their region and just focus on building Indiana from the ground up, quality of life things. And, that's just one small part of what we're doing. We've got some new programs that have come through, but, the great thing for us is with Indiana really not shutting down our manufacturing and industrial sector, a lot of work came to Indiana from other states that did shut down. And so from a fiscal point of view, we're really looking to our industrial sector, and we're really wanting to support them. A lot of our gross domestic product in Indiana is in the steel and automotive industry. Life sciences is strong too, but great thing about Indiana, we've got 6 OEMs in the state. The concern we have is 5 of the 6 are still combustion engine vehicles. And so we're going to look at a long term investment strategy with that sector, using a lot of these federal dollars to really retool the automotive sector and keep Indiana's prominence in the automotive world.
Terrific. Okay. I want to come back to you a little bit later on, just focus a bit about the Northwest Indiana, submarket and how kind of Illinois' approach, as it may be different than Indiana, has impacted you. So put a hold on that for the moment, but anybody else in terms of policies, seeing an impact on?
Yes, CenterPoint, I think historically does about 15% of our capital deployment is in infrastructure. So we currently have a toll bridge going in Joliet. We've done rail projects, et cetera. So I think we're hopeful that this would be, again, kind of increasing the partnerships, public-private partnerships, leveraging that capital to do some of this and sort of continue to increase the investment appetite in infrastructure, because I think the US and North America has probably been lagging again relative to what you see in Australia, Europe, et cetera. So hopefully we can continue to do some of that. Again, I think one of the interesting parts is what's traditional bridges, roads, et cetera, in that bill, and what's sort of the alternative, either the other miscellaneous money or, what's the sort of new technology type driven infrastructure.
Thanks. It will be interesting. We've been hearing for a long time, I think, about the increase in PPPs. We had the Skyway, we had the Indiana Toll Road, as examples, looking at airports, and then it seems to have slowed a bit in terms of excitement. So perhaps that's something that is reinvigorated. Great. So let's focus in on markets a little bit. So Renee, I'll start with you. Just you've got a national perspective in your portfolio and your mission. How do you view Chicagoland relative to other markets across the country?
Yeah, I mean, that's a question that every sort of capital allocator is thinking about, and that's sort of the perspective that I'm bringing, is sort of investing in Chicago versus a tenant who's already here and serving the market. They are here because that's where their business is. We are here because we either choose to be here or not to be here, right? And so from that perspective, Chicago is, it's interesting. It's a little bit challenging because you've got sort of two schools of thought on Chicago. One is it is the second largest industrial market in the United States, right? If you take Southern California, it's bigger, but other than that, Chicago is huge, it's massive, it's very easy to deploy capital here. If you have a big enough platform, I would almost say you almost have to be here just to be able to, place enough capital. And then you've got the other school of thought, which is, well, we don't really buy buildings, right? We buy cash flow. The buildings generate that cash flow, but not every building is the same, right? And if you start looking things like growth and sort of economic activity, population, all of those, Chicago suddenly starts to fall off that list. It is definitely not at the top of. In fact, most people probably know that Chicago has had negative population growth for a while, and I'm pretty sure post-COVID, the first statistic we're going to see is going to be probably pretty negative. Hopefully, it stabilizes. So, I mean, I know there are a lot of groups out there that they just don't invest here, right? I'm still a believer that Chicago has the critical mass. There's a lot of people here. Even if you lose some, there's still 10 million people stay. So it needs to have the infrastructure to support that kind of population. I look at these markets. I think Chicago is more of a infill market that you play maybe through obsolescence. And then you look at sort of Dallas. I was in Dallas this week. You look at Dallas, and I always call Dallas, it's like the China of the United States. They're building subdivisions and roads and interchanges, and it's crazy. And there, obviously, you play the growth. So Chicago definitely plays a big role. Obviously, CenterPoint has invested heavily here because of the Class A railroads all meet here. People say there's more containers coming through Chicago than through any port in the United States. So it is still a very, very, very dynamic market from that perspective, but there are some challenges here as well.
Yeah, I mean, Brian, do you want to focus on, CenterPoint's decision-making process, at this point, as we turn the corner? What are the factors that are really driving you going forward? You're obviously, as Renee said, major investor in the Chicagoland market. Do you presumably see that continuing, and how has your outlook changed, if at all?
Yeah, I think like most funds or REITs, I think we're focused on growth. So that makes Chicago always a challenging, a challenging decision. So should you put your dollar in LA or New Jersey or Chicago? To Renee's point, right now, I think there's so much money out there, you do everything. But growth, I think, is a concern for us in Chicago. We've probably really focused on O'Hare and then the I-80 in particular, both based on the intermodals. So there's, some differentiator down there. And I think, we're concerned about growth. It seems good right now. What I do think there's going to be a 12 to 24 month where the construction costs, I think some of the entitlement challenges, some commodity pricing, just you can't get the commodities. So I think that's kind of squeezing some of the merchants that generally will drag or just keep the rates kind of flat over 20 years. So I think there's going to be a nice 12 to 24 month stretch. I think cap rates are pretty low. So there's just not going to be a squeeze. I think we'll actually see there's some potential for rent growth. Let's see, again, efficient markets and how people are disciplined will probably affect that. But I think it could be an interesting, I'd say year, 2 years run here.
And Beverly, how about you? What are you seeing in terms of submarket focus among your?
I have found there are always people who want to own their own building. That's just what it comes down to. So my owners are all people, they want the real estate. They want the bricks and mortar. And I deal in smaller buildings, 25 to 50,000 feet. But I promise you, there are always people who will buy that building, no matter where it is or what condition it's in. And I've had some pretty ugly buildings, but they've all sold. So I've been very lucky.
Okay. Okay. And any particular, it doesn't matter.
Much help, was it?
Sorry. It's fine. Anyone else seeing, want to focus on a particular area within Chicago? Adam?
To Brian's point, I think we're going to see rent growth across the market. I think we're going to see rent growth across the country with the commodities pricing. It has to go up. And Chicago's an interesting market because it's kind of the bottom of the top tier, if you will, as far as the national markets go. So, at what point does cap rate, I think we're kind of 4.5 is our marquee cap rate in Chicago right now. So, is it 4.75? All of a sudden people are going to start investing in Chicago, or does that have to get up to a 5? Or, where's that threshold where money starts really flowing in, and where's that threshold in relation to, some of the other marquee markets like LA and New Jersey? Is a 4.5 in Chicago better than a 3.5 in LA, or what's that spread have to be? So, I think that's one of the national dynamics that we play with as far as some markets in Chicago. We're focused on a lot of the outer submarkets where we see growth. I-80 for sure. We have a development we did last year 2 years ago out in Aurora, and we like that I-88 corridor. And then we certainly are heavily invested in Southeast Wisconsin, up in Kenosha County. We've had a lot of growth up there, and seen a lot of national companies with interest in Southeast Wisconsin for various political reasons, as well as the fact that there's land available up there, and less traffic, less constraints, and good labor.
Yeah, one of the things I think Adam brought up that's interesting, I don't know if Renee or anyone else has thoughts, but I think you see the coast and you're doing a 5 or a 6 IRR, and that's largely built on some pretty aggressive assumptions, almost double digit, rent growth or CAGRs that are, year after year, pretty significant. So at some point, I think getting yield back in the Midwest, I mean, I think at some point, I think that's another sell point here for us, is that to get a quote unquote fictional 5 or 6 in Jersey versus, getting a little more yield in Chicago or the Midwest. I think that's something to think about.
I mean, that's That's interesting because that's absolutely right. I mean, if you think of like Chicago last, I guess now it's 2 cycles ago, 2007, 2006, it had one of the lowest cap rates in the market. You're saying 4.5 here. We just lost a deal in Atlanta, 3.75. We just lost a deal in Baltimore, in the corridor, Baltimore to DC. It was a sub 4 cap rate. So Phoenix hit a 4 earlier this year. So if there's that's sort of two metrics if you think about it, right? There's cash on cash, and then there's IRR. And you when you start balancing those out, suddenly we actually we submitted a bid on a deal here yesterday, and the more of a certainty of the return, the rents that are in place did make it more interesting than most of the other stuff we looked at. As I said, I was in Dallas yesterday. The deal we wanted, it's going to be a probably 3.75 cap rate. So I think that's sort of how Chicago stays in the mix. You're probably going to buy Chicago now more like you buy a lot of the other Midwest markets, which is more of a yield play. And then you buy the other markets, and even historically secondary markets like Tampa, for example, and you'll buy those for growth.
Thanks. So Jim, let's come back now to the region in Northwest Indiana and its role in the Chicagoland industrial market, and how would you see that as having benefited from perhaps different approaches between Illinois, Indiana, and going forward, how do you view that sector?
Well, I think, and this goes for any state to state comparison, and right now is a great time to really listen to what people say, but more importantly, watch what they do. And, a lot of states with the stimulus money are taking it to plug holes and, kick the can down the road, if you will. And we're investing in Northwest Indiana a lot. The double tracking of the South Shore up there is going to be a game changer in terms of getting people in and out of the metro. But, we're seeing a lot more property open up in Northwest Indiana, and that's always been a challenge. The availability of industrial land that hasn't been a former refinery or steel mill or something like that, those are getting turned around. We're actually seeing the perception lessen. When I was working in Matt's role as our Northwest Indiana Regional Office Director, the challenge was companies were more than willing to come and look at Indiana. They get it that we're a steady, predictable business and regulatory climate, but it's that devil you don't know. And moving across the line, how many of my people will come with me? So we're working on trying to get Northwest Indiana, the overall market, to be even a better place to live as well as work and locate your business. But we're breaking down those perceptions that you can't really make it work beyond east of I-65 or south of US 30. I mean, when I was here, people wanted to stay north of the Mormon and west of Klein Avenue. And so now, as people are looking further east and further south in Northwest Indiana, we've seen a lot of opportunities. There's an industrial park in Merrillville that probably will get filled up by the end of the year. And we're just inching down I-65, which is going to get 3-lane, ideally all the way to Indianapolis in the foreseeable future. So, we feel like it's a great market, great potential. It's been somewhat overlooked just because of what's been in Northwest Indiana. But right now, I think from a policy perspective, we're still looking to partner and looking to help business, make good decisions to come here. But again, I'd love to pick on Chicago and tell you all the things that are wrong with, one government, one set of government versus the other. The honest fact, and it's what you all have talked about, a healthy Chicago, a strong Chicago means great things for Indiana as well. And so, we're rooting, for that to happen. And as this momentum continues, I mean, we still get our shots on goal, and normally when we get the shot, we hit it. So.
Thanks. Well, I guess I'll open it up for anyone else that wants to pick on Chicago or Illinois. It's from the perspective, when you're making your decisions and you're looking at properties, how much, if any, these policy decisions, whether it's taxes or, you know, lockdown policies, et cetera, influencing, anything that you have done over the past year, or, that you see being a major factor going forward? Would you look at Indiana versus Illinois?
I think from an investment standpoint, not necessarily COVID issues. I think that's sort of short-term political issues. I think how the states run and how attractive it is for businesses is obviously a huge focal point for us. And I'll just use in the Midwest, you compare it against Texas. I think that's pro-business state. To Renee's point, they're just investing in infrastructure, attracting businesses, I think largely due to that, and employees for those businesses. And so, I think those are concerns to us, hopefully with some of the stuff that's gone on in the city in terms of, cleaning up politics slightly, and then hopefully at the state level, I think those are concerns that investors, not just REITs that live here, but I also think kind of, the national funds are focused on that.
Right. And property taxes has also been a big question mark, huge question mark over the past couple of years. You feel that's been starting to see some more certainty around taxes that gives you more ability to factor those question marks into your deals and pricing?
I would say probably not yet. As I said, we don't buy buildings, we buy cash flow. So anything that makes that cash flow less certain makes it riskier, and risk means you are willing to pay less. And so, Cook County definitely has a bad rap because of the uncertainty. I think investors outside of the area, they are much more likely to buy in DuPage, for example, than in Cook County. Now, the interesting reality is because values have gone up everywhere, all over the country. No matter where you buy, your taxes are going to go up. Now, you always prefer your taxes to go up because your value went up versus just because the rate went up or something. I look at it a little bit from a buyer's perspective. I'm not sure to what extent I care why the taxes went up, as long as it's in my underwriting. As long as then you think, okay, now the taxes were right-sized and they're not going to go up disproportionately anymore. I'm not sure there's 100% feeling that things have been right-sized, so there's enough evidence of that. But that would be when maybe some of that fear goes away. We also buy multifamily assets, and because those are obviously gross leases or equivalent of gross leases, they just pay you. We are way more concerned on that front than on a lease that's net lease, right? There you can pass it through, but it does impact the ability to also push net rent if you're already pushing the gross number up.
I think one of the important things to remember about Chicago, and I think Jim touched on it a little bit, but if you look at where we're located geographically, based on the railroads, based on the highway system, and the fact that there's 9.5 million people here, it's always going to be an important industrial market in the United States, and one of the top 2 or 3 in the United States. So, it's easy to kind of start to get frustrated with some of the things politically and otherwise, the weather. But fact of the matter is, until about 6 million people move away, it's always going to be a major industrial market.
And piggybacking on that a little bit, I would agree. I've got owners who finally said, you know what, my taxes are high, but that's just part of the cost of doing business here. My family's here. I've been here for 3 generations. We're not moving. So they're accustomed to the fact that, okay, taxes are higher in Cook County than someplace else, but they want to be in Cook County for a variety of reasons. And the taxes are as part of the package, and they're getting more and more used to it.
Okay, so let's shift again back towards policy, but this is, even before the administration, which is obviously turbocharged the movement, green energy, climate change, ESG, have been major factors leading into COVID, and there's obviously a huge emphasis on these policies now. Institutional investors are more and more pushing ESG as major influence in its allocations. What do you think this means going forward? I'll throw it to you, Adam. Just for the industrial market?
So ESG is an interesting, it's really kind of come to light in the last 3-4 years. Our model, our mantra at First Industrial is to do the right thing for the owners of the business, the shareholders. And if you look at ESG, really a lot of it is doing the right thing for the shareholders and everybody else. The environmental policy is something we've taken a real hard look at. And, a couple of things we've changed. We buy all of our energy for our buildings in Chicago where we pay the bill. We buy it all. It's all renewable energy. So that's been a big change for us. It's just kind of looking at that. And one of the interesting things was when we started to go through that process and look at that, we found that by brokering our energy, even though it's all renewable, we're still saving 30-40% over just buying it from the standard public utility. So what we've been able to do is kind of do the right thing environmentally and save money. And that's a win-win. One of the other things we're looking at is moving forward, putting more emphasis on LEED construction techniques. And that's been interesting for me to kind of look through that and understand the point system and everything else, because there's some points where they don't cost much, but they don't really seem to do much for the environment. Is somebody going to ride their bike to the middle of an industrial park that's 5 miles from, the nearest house? Probably not. So, what good's a bike rack really going to do you? And then there's other things in those points where you look at it and you think, boy, that's not that expensive, and that could make a real big difference. Some of them even save you money. Hey, we're not going to irrigate the plantings around the office. You get LEED points for that. It saves money and it's good for the environment. So you start to look at some of these things and really pay attention to it. And I think that's hopefully what this ESG movement is going to drive across our entire industry.
Yeah, I would say industrial's been a latecomer compared to some of the other property types to ESG. Probably the reason why, because not that long ago, industrial buildings were worth $60 a foot. And at $60 a foot, it's a little bit harder to afford these extras. Right now, industrial buildings are worth 150, 200, or more, depends where you buy them. That's the price of an office building, suburban office building. Suddenly, it's a little bit easier to do these extras. But it is becoming a much more significant part of it. And it's not just a slogan or acronym or whatever. It's something that's going to be around capital partners care, institutions care. It is very important to pay attention to this, and it is long-term good for the environment, good for the community. So it has other benefits, but I think it's a little bit easier to make it work when industrial is worth 2 or 3 times what it was worth 10 years ago.
Yeah, I'd agree with that. All the clients that come to see us, 10 years ago, it wasn't part of the conversation. And today it's usually one of the lead issues that is brought up. And it's, up and down the supply chains, as we move into electrification of our vehicles and, as steel mills go to electric arc furnaces, things like that, the ability to track that footprint all the way down your supply chain has become a critical part of the decision-making process.
I think what the problem to me in industrial has been, you just don't get a return for it. No one pays you for LEED. You generally don't get the same operational savings that you would in, say, an office building downtown. But I think we've started to see, again, owned by a California public employees, so we're hyper focused on ESG. I think you're starting to see what institutions in the capital side have done. So you're not necessarily getting paid more rent for it, but maybe your debt's cheaper. So we're issuing bonds that are sort of green bonds, if you will. You see what Blackstone's saying, Jamie Dimon's saying. So I think you're seeing, you may see it on a lower cost side from capital or getting, the ability to attract funds. So I think that's going to drive it really more mainstream, because I'll tell you, I don't see any tenant willing to pay an extra dime for a LEED, but I do see, maybe you won't get the tenant or you won't get capital to invest in your building or buy your building. So that, I think that's really going to drive it. And I think that's going to make it sort of a table stakes type decision for most developers or owners.
So how about other technological changes that users and tenants, are really focused on, robotics, solar? What's Beverly? What are your
No
customers?
robotics in any of my buildings, but a
Mhm.
couple of owners are finally going to put solar panels in. They've been talking about it for years. I don't know if they had too much time on their hands during COVID, but they finally figured out where they are and how they're built. It works to their advantage. So a couple of guys I have moving forward on solar panels.
Anyone seeing, other demands, kind of like the amenity wars in multifamily, but what's the equivalent?
I mean, I think we're focused on what is, sort of future proofing, if you can, your building. So, electric vehicles, that's the easy one, both on the auto and the trailer side. Is that something you should think about setting the building up for that going forward? So that, I think that's something we think of. We are seeing, I think you see labor as such a constant issue in industrial nationally, but definitely here in Chicago. But we've seen people go to more, not necessarily robotics like the Kiva Amazon system, but more robotic systems in a forklift or picking. So I think you're seeing that because it's a way really to hedge the labor issues as much as it is sort of a responsible, ongoing ESG type measure.
I think on the labor side, we're certainly, you're always looking to try to future-proof your building, right? At one point, 24-foot clear was pretty high. So, we're looking at, 40-foot clear for most of our larger new developments. We're really paying a lot of attention to car parking or the ability to add very heavy car parking like you see some of the e-commerce users requiring. And then we're trying to separate trucks and cars and with drive aisles and things like that. And that all is applicable, very applicable today, and tenants want to see that today. We also think a lot of that is going to be very relevant in the future as we move more toward electric or autonomous vehicles, trying to figure out how to separate those autonomous trucks possibly from the cars and things like that. So we think that's a kind of a double future proof, and we're always looking at things like that. And then the other one is that we've seen a lot of lately is dock packages. 10, 12 years ago, there were maybe once a year, once every 2 years, somebody would ask you about dock locks and you'd price them and then they wouldn't put them in. And now it seems like a lot of the larger tenants are requiring dock locks. As a matter of course.
So you touched on labor issues. You mentioned previously construction prices. So there's been huge disruptions to the supply chain, to the labor market. So how has this impacted your ability to do deals through COVID? Do you see things opening up from that perspective? And Renee, I'll throw it to you.
Yes. Things are definitely opening up at different rates, different parts of the country. I mean, labor is, that was like the number one topic before COVID, right? Because if you think about it, you used to have a 400,000 square foot warehouse and it employed 50 people when it was Home Depot, right? You have if it's Amazon, it's multiples of that, right? And then if, during the holiday season, they go to 3 shifts and these 1 million square foot buildings, suddenly they could employ, 1,500 people per shift times 3. That's sort of like a lot of people. So that's one of the reasons why some of this, Kiva and all of that starts to play a more significant role. Clearly we still have 9 million plus or minus people that are unemployed. So, but at the same time, labor is still an issue. We have unfortunately created in some instances disincentives to work right now. People think in anecdotes. So an anecdote, I have a friend who runs a plant here in the Chicagoland area. It's a plant of about 1,200 people, and he has 300 openings that he can't fill. That's like a lot. And so I think labor will always be an issue. We're starting to see wages being pushed up. You have the $15 minimum wage. So there's going to be push and pull on that. But the more the economy opens up, and the more people go to work, if you sort of try to link it back to demand for industrial space, more economic activity is good for us. Right now it's been good for us because it's been mostly e-commerce. I like to say if there was one person who didn't shop online before COVID, that person no longer exists. But we need additional other economic activity as well. So the demand for space can be a little bit more diverse, across the market.
Jim, how's Indiana tackling these issues?
Well, a couple of different ways. Going into the pandemic, we were at about 3.2% unemployment. We're at 3.8% coming out, the last data that we have. That increment is essentially hospitality and retail sector jobs. And so what we're doing is we're focusing on those employees from that sector, reaching out and saying, look, if the uncertainty of the retail sector or hospitality sector is of concern to you, we have training programs that we can put you in that can get you certificates, that can get you skilled up to take some of the job openings that we do have. And as Renee said, every company you talk to in Indiana could use, 50 to 100 more people. But we're seeming to get those jobs filled. The wages are a big part of it, but we're also seeing the work policies. When do I have to be at work? What's your remote work policy, especially for younger workers? That's been important. But really, we've just continued to target, the opportunities for pulling new people into the labor market. We're at a little bit of a challenge in that our labor force participation rate in Indiana is about 2% higher than the national rate. So most of the people in Indiana who want to work are working. Some of the lower tier supply chain, lower wage jobs are having trouble due to the stimulus and the payments. But as those wane, we hopefully will start seeing, that unemployment rate tick down to below 3 in certain areas.
Terrific. So I do want to leave some time for questions from the audience. So maybe just to wrap up, the panel here, if you could just let us know what's your level of optimism. So the market has been red hot. How will it keep up? For how long? Tell us in 20 words or less. What you think over the next 5 years. Can we keep this going?
I think it's going to still be good. I think it's going to be very good. And you said in 5 or 10 words or less, I'd say it's out there. Go get it.
Okay.
Yeah, I think industrial to me is going to be hot for the next 5 years. I think good functional buildings. I think trying to keep some grasp on fundamentals, but still participate in the market is sort of the key.
Yeah, I agree. On a scale of 10, I'd say 11 or 12. I mean, it's and I look to consumer patterns and also to the constant change in technology and the velocity at which that technology is changing. I mean, as I said, we have not only in Indiana but throughout the country, we have an automotive industry that has to change from its foundation up almost, and same with a lot of other industries. The energy industry as well. I mean, we're seeing just huge change across all sectors, and I think that gives me a lot of hope and optimism, in the short term.
Okay.
Well, when I checked into my hotel in Dallas on Tuesday, the guy who was checking me in told me that COVID's over. So it's the first time I heard that, by the way. So I'm very, very optimistic.
Excellent.
I too am very optimistic for the next 2-3 years. I think we've seen a lot of accelerated demand due to COVID, and one of the things that I'm watching out for is what happens. Are we pulling demand out of 2024 or 2025 and pulling it back into 21? So that's something I think we need to watch out for and make sure we don't get overbuilt and don't get out over our skis. I think it might have happened once back in the 2008 or so. That some of you may remember, but so cautiously in the midterm, in the short term, in the next 2 or 3 years, I think it's going to be very good.
Thanks. I think we have about 5 minutes. Yes.
Sounds like a Renee question.
Well, I mean, the rent growth is playing catch up, right? We had a comparable negative last year, right? This year, so there's not a lot of catch up for industrial to play. A lot of that growth is going to be in the hospitality, travel, all of those industries. So as I said, anything that's good for the economy is good for the industrial market. Any product you'll ever see or touch has probably gone through an industrial building in its life cycle at some point. So it's going to be good, but it's not going to accelerate. It's not going to translate sort of one-to-one for demand for industrial because we never really stopped.
Yes.
I don't think it's flipping back, but essentially, I think e-commerce was one of those industries that got sort of pulled forward. Things that were going to happen maybe over 5 or 10 years happen over 5 or 10 months. So there was definitely this reacceleration that, in my opinion, will slow, but we are not going backwards. There's still lots and lots of headroom, right? I mean, when we started e-commerce, about a third of all transactions, B2B, were online, and only 10% plus or minus B2C. So there's still a lot of headroom. It's not infinite, obviously, but we've got a lot of this still to go.
I mean, probably also a variable there as to, how many people are still going to be staying at home, and, are people going to be heading back into the office? Are they going to be home to do the online shopping, or, out and about?
I don't think, generally, I think it's going to keep moving forward at probably at a slower rate. I mean, there's, like you, I wasn't a big e-commerce shopper, but there's some things it's so much easier. You're going to get in the car and drive to the store to pick up vacuum bags, or you're going to click a button and they show up the next day at your door. You're probably going to click the button going forward because it's so easy. Food, some things like that you need immediately. I think people start to migrate back to the stores where I don't want to wait a day or two. I want it today. But overall, I think that growth rate slows down, but I think it's still growing.
More?
Yeah, we're studying our energy policy and our energy infrastructure. We were doing so long before the unfortunate events down in Texas and the weather issues down there. But Indiana right now is the private utilities in Indiana, the investor owns, are all in the process of decommissioning their coal-fired fleet. But the great news on that is they're investing in other renewables, and kind of diversifying their portfolio. They'll still maintain, I think, a certain percentage of their fleet in natural gas. But I think the great thing about Indiana and frankly, the Midwest, Chicago, we're a manufacturing state. So our infrastructure is heavy and it's reliable. And I'm not overly concerned that we won't be able to meet the demand, but how we do it and if we can maintain our reliability is going to be critical. But at this point, all indications are that we're in good shape to move into that world, provided it doesn't happen in the next day.
One more?
We have two projects going, not here in the Midwest, but one in California and one in on the East Coast, converting old retail to Amazon. Yesterday, I was talking to a retail developer, grocery developer, and they're doing. If you see the Amazon in Schaumburg, there's about a 25,000 square foot store that's kind of a hybrid, half retail, half e-commerce. So I think that's definitely going to be the future. I mean, I think it's almost like that's here already. I think it's just how municipalities kind of adapt to that. But from CenterPoint's standpoint, we're investing in it and think that's definitely something going forward.
Okay. All right. Well, thank you very much to the panel. You've been outstanding. Thank you to our IREJ. Thanks for getting us here in a room and off of Zoom. We appreciate it.
Okay. Yeah. Okay, we're going to transition into the second panel. We have a formal break after the second panel. So give it about a minute or two. We're going to transition into the development and leasing trends panel. So if you have to take a break, keep it only about a minute, please, minute or 2 minutes. We want to keep it moving. We have virtual audience. Want to stay on time. We will take a 10-minute break after the second panel. Couple other comments. I don't have my notes. What is it? FBL? JBL? And also Finishing Chicago. Stop by Finishing Chicago's exhibit. They have a promotional giveaway, a JBL speaker. And also Bid Evolution. Bid Evolution is in the back. They are also our sponsored exhibit sponsor. They can talk to you about getting in contact with a contractor. Dan Cawley is here. That's your group, Dan. About another minute or so. Okay, let's take our seats, please. Take our seats. We'll start in about a minute. Finish up the conversation. We're going to get into the next panel, moderated by Dan Cawley of Cawley Chicago. Going to get into talking about some development and leasing trends, right, Dan? Take your seats, please. I know we haven't seen each other in 12, 14 months. A lot of industrial brotherly and sisterly love out there, I understand. Let's take our seat. I know. Hugging someone is, you can't hug someone on a Zoom call. Thanks for being here, guys. Appreciate your time, expertise. Glad we put the program together. And, an interesting trade. Yeah. Okay, again, I want to give special thanks to our sponsors. I have to apologize. Bid Evolution is also a key sponsor of our event today. Bid Evolution has a tabletop in the back. Steve can talk to you about getting in contact with some select contractors. Talk to them about what Bid Evolution does. So again, Bid Evolution is one of our key sponsors here today. All right, let's proceed. Let's get into it. You need this? Yeah.
That's mine. I got one right here if you need this. Great. Morning again. Thanks everybody for being here. Feels kind of weird actually to be standing up in front of some real live people. I'm Dan Cawley. I'm the president and founder of College Chicago Real Estate. That happened 23 years ago when I was 12. So we're a full service commercial real estate brokerage company. And what we're all about is we create, maintain, and monetize value in commercial real estate decision making for mid-market business and property owners. That's what we're all about. So we've managed to survive through 2000, 2008, 9, 10, 11. And then last year, which was really interesting, I'm sure, for everybody. So we're gonna take a couple of minutes and let these young men introduce themselves, give you a little bit of background on what they do, and we're gonna talk about the wave that's happening. So whoever wants to go.
Sure, I'll start. So my name is Craig Daniger with Clarius Partners, Senior Vice President. So Clarius, our mission is to provide measurably superior results for us and our capital partners and our clients with aligned interests, so that at the end of the day, we're all happy to share in our successes and do business over and over together. So
I'll go next. Kyle Schott. I'm Director of Development with Ryan Companies. Ryan Companies has been in the business over 80 years. We provide cradle to grave real estate solutions, from development, architectural and engineering, general contracting, capital markets, as well as property management. I've been with Ryan 18 of those over 80 years. And my focuses are industrial development here in Chicagoland, as well as our Great Lakes region. Now, part of my history with them has been on the construction side of things. And I feel that allows me to bring a different perspective when we're talking about solutions for our clients or real estate deals.
Good morning. There you go. My name is Joe Rook. I'm with Arco Murray Construction. We are a design build contractor that specializes in partnering with customers and clients all across the country and delivering a turnkey construction solution. I'm a principal here in Chicago, and I help lead our industrial practice group locally.
I'm Kyle Grant. I'm with Venture One Real Estate. We own, operate, develop warehouse buildings, throughout the greater Chicago area as well as New Jersey. I've been here about 5 years now, and I oversee the leasing for the Chicago portfolio.
All right, great, thanks. Everybody hear me all right? So the first question I have is, what's the single best change to your business? Or what have you changed in your business as a result of COVID?
Well, yes, I can start. One thing that I've noticed is that because of all of this, clients, municipalities, my peers have become more savvy and comfortable with online communication. And because of that, I found speed to getting things done. That may sound counterintuitive going through COVID, but after those first couple of months, it seemed like people really embraced it. So instead of spending time to organize a group of 15 people to go to someone's office, travel to another area of the country, you're doing it online. So while it, like I said, counterintuitive that COVID would slow things down, I've actually seen it a little bit different, where it's sped things up, sped up those paths of communication.
Yeah, I would agree with that in terms of the way we do business. Virtual meetings has changed things tremendously. And at the end of the day, I think we're all just much more efficient than we were before. And in large part, that's because of less travel time, whether it's out of market or even in market. And at the end of the day, nothing can beat face-to-face interactions to develop and solidify relationships, but there's plenty of benefit to having virtual meetings to just maintain those relationships or have certain types of meetings. And even with municipalities now adopting a lot of virtual city council meetings and plan commission meetings and so on that a lot of us are involved in going to, that's allowed for just a lot more efficiency in what we do on a day-to-day basis.
Yeah, I'd say brokers seem a lot more excited to see me in person at vacancies. So that's been the one change since COVID. But just to piggyback on all that, as far as a leasing perspective goes, I'm trying to take a closer look at how we market vacancies and how we can efficiently allow prospective tenants to tour when, maybe someone isn't coming to town. So whether that's a Matterport walkthrough or, just having photos taken more regularly and updated on brochures, that's something that we're trying to, I think, assist where people are looking for, technology to help, create more efficiencies as far as how they go throughout their selection process and work with brokers on that.
Yeah, I don't think we fundamentally changed too much in our business. I think we obviously adapted. I think the thing that we're the most proud of as kind of the contractor on stage is that we didn't overreact to the situation. Ironically, we're predominantly an industrial builder, but we've been working hard to grow other verticals in preparation for a recession, thinking that industrial's kind of the most recession liable. And, in a weird turn of events, we ended up being kind of the group that helped carry us through and just getting creative, getting gritty and utilizing our resources and cross-training our resources. So now coming out of this, we feel like we've got a deeper team and our best resource, which is our people, is that much stronger coming out.
So I just started wearing pants about 4 months ago. So by a show of hands, how many people had their very first Zoom meeting as a result of COVID? Zoom or Google Meet? Yeah, right, cool. All right, so let's get into the business aspect here. So there's a wave, obviously, and the previous panel had kind of discussed there was a bunch of pent up, right? And nobody could figure it out. And so all of a sudden now this wave is happening. So I've been doing this for 44 years. This seems like the biggest wave I've ever seen. And happening at a tidal proportion. So coming out of 8, it was slow, right? 8, 9, 10, 11, it kind of dragged in, it kind of jumped, but nothing like we're seeing now. Love to get your input and thoughts on why you think that is and how long do you think it's sustainable?
I'll start. So I think two things. One, I believe that more than 10% of people, really switch their habits towards e-commerce and also the amount that they were buying. So I think that the supply chain had to react to that, and that change happened immediately. And, end users were changing these habits, and I think it's for the long haul. And so e-commerce had to react to that, and that caused an influx of, needing buildings and things like that. And secondly, the supply chain got a gut check, and inventory was not there when it needed to be. And I think that a lot of our clients are now right-sizing that inventory. And that means additional square footage, whether that's type A or type B facilities, the space needs to be there. So you're seeing that reaction as well.
Yeah, I think any change as drastic as we're seeing is a combination of things. And I think aside from kind of the demand side of things, I think in Chicago as a contractor, we're limited by the window that we can get construction done. And as unaffected as industrial seems to have been last year, I think the timing of March, April, May, when a lot of these deals need to come together to break ground in the spring to be able to get done by the end of the year, was really challenging, because even if the deals were still penciling, there was problems with financing and there was just delays in general. And I think that combined with all of these other factors, we've got a lot of deals that I think were slated to go last year that were racing to try and break ground by the end of the year that just barely missed that window. And now this spring, this year is kind of a built up combination of all these deals from last year that didn't get a chance to start, and then everything going through the winter and all the increased demand kind of all combined is creating, at least from a construction standpoint, a lot of the challenges that we're seeing here starting this year.
So a perfect storm.
Yeah, I think in a lot of ways, what we've seen is several years of e-commerce growth packed into 1 year. And, that's created, part of this title that you've called it, Dan, and inventories as well for the supply chain challenges that we all experienced in certain ways about a year ago. I've heard that inventories among a lot of companies are increasing by as much as 50%, which obviously has a tremendous impact on warehouse space. And the third thing I think is onshoring of manufacturing. And I don't know how many businesses are actually bringing manufacturing back from overseas to onshore. But I think there's certainly several manufacturers of new technologies that are developed in the United States that are actually choosing to manufacture in the United States rather than looking overseas. And we've seen it in really every market that we develop in, a major uptick in demand on the manufacturing side.
Yeah, and to echo Craig's point there, Amazon in 2020 leased close to 16 million square feet. Up until that year, the closest they had, done to that was 4.5 million square feet. So on a go forward basis, do you feel Amazon's going to lease 20 million square feet a year? Probably not. But, whether that goes back to their more stabilized, levels, or if it, has a drop or, a slight rise, I think, that's a good telltale for where at least they view, the e-commerce market and where demand's being driven for them. And a lot of those were, driven by big box leases too, which I think is important to note is how they start to, adjust how they distribute or, adjust that.
So you said right size inventory. Could you give us a little bit more what that means?
Well, I think what we saw was just increase in demand and product not being there. So I think right sizing that inventory is having, not stuff that is going to be flying off the shelves on a daily basis, but something that is almost a backstock of, products that people need should something else come up.
Right. So the old model was first in, first out. So it was all about making sure that there was very little time in the warehouse, right? Because people didn't want to have the space. So is that what changed then?
I think part of that for a certain product. Yeah.
And has ceiling height made that happen easier, do you think?
I do. And I think you're seeing a complete change from what was 32, 36 to growing to 40. I think that's technology driven. That's inventory driven. I think there's a lot of things that have to do with that change.
Yeah, I think, my dad's in the corrugated industry, and a lot of it is some stored product, but I think a lot of it also is just stored materials so that you can react to shortages. I know like in corrugated, there's a glue shortage right now because all the boxes coming out the door. And so a lot of the manufacturers are reacting, trying to store as much product, and it almost has a negative cyclical effect because there's a shortage and then people are trying to build up more and more stored product as a result. So I think for sure that's another factor in it.
So I was told recently that the first thing that causes obsolescence in an industrial building is the ceiling height, right? So if you can, you look at the generational changes in industrial development, 16 foot, 14 foot, 16, 20, 22, and now here we are pretty much 40 is where everybody's headed. Let's talk about some costs potentially that are involved in this kind of stuff. So, and potential lead times. When we have a demand wave like we're experiencing, there's going to be shortages and time. It's going to take time to get what they need to get to put the buildings up. So let's talk about some of those things. Precast. Let's talk about precast. What's the out time right now? Lead time.
Yeah, in a weird way, precast is less affected than the steel. We can talk about steel for a second.
Why is it weird?
It's weird because it's the first time in my career that the steel has a longer lead time than precast, which is atypical. I think in talking to some of the joist and deck manufacturers, they've only had a lead time that exceeds 20 weeks once. And the sales guy that I was talking to had worked there 40 years, and that was in the late 90s. And right now we're at 35 to 36 weeks. So we're drastically past what has ever been before. So right now I think precast is probably in November timeframe, but that's still 2 months ahead of steel. Steel's officially into January if you were to place an order today. And so it's not that precast is off the hook. It's just that it's not as critical right now as the steel.
And to think about the change that happened in steel. I mean, I would say at the beginning of this year, we were probably at 16, 18 weeks, maybe with steel. And now you just heard 35 to 36. That's a huge impact. And let's just talk schedule alone and how that's being mitigated by certain clients or certain developers is going at risk earlier with dollars and putting dollars down on steel. And that's how you can mitigate that. But that's, again, getting a little bit more risky to manage schedule.
So being around for 44 years, the way it used to happen was everybody inventory land. That's how they controlled the development. 55 is a perfect example of that, right? And so then when the crash happened, 8, 9, 10, 11, 12, nobody wanted to inventory land. Everybody's trying to get rid of it. Centerpoint went through a huge change, trying to dump a bunch of land, right? Not being critical, just that's what happened. So now it's changing even more based on the ability to potentially stay in a building longer with ceiling heights. So let's talk about scarcity of land. What are you seeing there? And let's talk about, has the entire Chicago market become an infill market? I think one of the guys in the previous panel mentioned that, and land costs. And are there additional political requirements, obstacles, and that would include environmental in terms of trying to get something approved? Joliet, for example, has got a moratorium on industrial development, right? If it's not already zoned, you're probably not going to get it built. So let me get your input on that, please.
Yeah, I think you've seen, close into population centers, Central DuPage, the O'Hare market, essentially DuPage County too over Cook is, really become infill at this point. You're doing land assemblages, you're looking at tear downs. You're seeing, a few developments go up in Elmhurst. In 2018, we built a spec building in Elmhurst. It was the first spec building that was built there in, I want to say 30 years or something. And, now I think there's 3 up out of the ground there. So, you've really seen, I think, a change. And part of that, I think, is driven by, you're seeing some real rent growth in the O'Hare market. And that's, able to keep up with, as construction costs are rising, also able to keep up and help some of these, what previously weren't redevelopment sites turn into redevelopment sites because you can make the numbers work.
Kyle, you said real rent growth. Can you give us something more specific than that? Can you give us a percentage? Are we seeing 20% increases in rent, 10% increases in rent?
I don't think 20% at this point. We're not Jersey, but you're seeing, I do think you're able to finally have the conversation with tenants that a space maybe 3-4 years ago that was leasing at, the mid-8s net for, a new spec building. All this is dependent on size and, whether it's class A, class B and whatnot. But, I think that is pushing up, 50 cents or so. We're looking at Glendale Heights now. I think you see the spec buildings. We have a spec building up there. I guess now TA just bought from LPC has a building there. ML has a building there. And I know there's some in Elmhurst too. That's starting to see, call it, in the 7s net, which, previously the high comp for the area, had been mid to upper 6s net. So, is a percentage basis, and what that is year over year, you could do the math on that, but you're not, you're not stabilized like maybe what you've seen historically in like a Bedford Park or something like that, where you had always seen sort of mid 3s net, regardless as the renewal comes up, it just resets to that.
And is there a flight to quality? A is like the darling, everybody wants to be there.
I don't think obviously you're always going to have tenants that are willing to pay a premium for Class A product, but we've actually seen, I think, a real drive for Class B functional product as well, just because, honestly, it's still below replacement cost. You can't build it. And there's always someone who, doesn't need the high clear height, whether it's a light manufacturer or it's someone who wants to, air condition the building in 32-foot clear. It's just more cubic feet they need to, have climate control in. We've actually seen some real rent growth in Class B as well because of that. And, at the end of the day, especially as you dive down to, under 20,000 square feet, you don't have that in Class A. There's not too many spec buildings that are getting demised to that square footage. So all you have is Class B product to compete with. And, as there's more and more demand in that size range, call it 5 to 20,000 square feet, there's no increase in product type like you have on the Class A property sector. So, that dynamic, limited supply with increased demand, equates to rent growth.
Anybody else?
I was just going to speak to infill. I think certainly infill is more challenging to develop. And I think there's a lot more unknowns when you go into a land site that you're trying to redevelop, and you don't know what you know until you know it. So until you do the geotech report, until you do a lot of the environmental testing, you're working to build, at least for me, I'm working to build the best cost assumptions I can. But I think as a result of that, you need to be looking at more sites, right? I think in order to have your deal flow kind of move forward on less predictable deals, you got to be looking at twice as many. So I think we're seeing a lot of activity and a lot of sites and a lot of people looking at things, and time will tell which ones of them really pencil.
Getting a broader look at sites? Are you expanding the geography?
I would say I was focusing more so like on the Chicago infill market. And I think you have people who own buildings.
Chicago meaning city or Chicagoland?
Chicagoland. But all these infill properties, I think you have people who own the land that are trying to test the markets to see how much they could get. They might be an existing building that is functioning just well and owned by the user, but the user is trying to take advantage of an opportunity. And so there's a lot of people kind of testing the waters, and there's a lot of deals out there to consider.
I would say as far as land goes too, even 2 years ago, it was hard to find actionable land. And by actionable, I mean, ready to go, shovel ready, fully entitled, serviced, et cetera. And back 2 years ago, land pricing started to tick up quite a bit. But what we've seen now in the last 12 months has been unprecedented in terms of land rent growth from what I've ever seen. And, that scarcity that we saw a couple of years ago is now even more pronounced. And so it's definitely created a challenge, and you're almost relying on supply constraints that result from land pricing and from materials pricing to limit supply while we have this demand with us, so that supply demand dynamic can be such that rental rates can continue to grow.
So I've lost all my hair, but I understand that have you all gotten used to having hair on deals now? Have you guys gotten a little more patient with, because I can remember bringing deals that was like, I ain't doing that. It's too much trouble. I'm not going to do that. So has that changed with y'all?
Yeah, I think the word I would use is creativity. You got to kind of get creative with deals now. Hair just is part of it, whether it's an assemblage, whether it's environmental, whether it's the municipality and your rezoning. It's hard to find that perfect site that's zoned industrial, that's ready to go and or shovel ready. It just doesn't exist nowadays. And you know, if it does, it's out there. It's in the secondary market, tertiary markets. Those are, I mean, there's land available. It's just, is there a need out there yet? And I think we may get there. But to answer your question easily, yes. I mean, every project now has some element of that.
Yeah, I mean, for us at Clarius, we've historically sort of loved at tackling projects that had hair on it. It was an opportunity for us to add value. But the challenge now is that, yes, we're still willing to roll up our sleeves and do that, but most land is priced as if there isn't that hair on it.
Some things never change. You made the comment about scarcity and that. So have you expanded your geography in terms of, and can you justify the expansion in the geography on a site based on what are the factors? Is it labor? Is it you're doing demographic studies? You want to make sure that there's access, ingress, egress, blah, 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 that stuff, right? So what are some of the newer qualifying factors if you're going to expand or jump or look at a particular site?
Well, I'll touch on labor just real quick. What I've noticed in some of the tertiary markets that we've been interested in or looking at is some of that labor is driving 45 minutes to an hour toward Chicago to work. And if there were product out there, you know, along I-80 out, you know, I think that labor is there and would prefer to be working at home. Are the clients, does it work for them? Is it a good enough location for them and their distribution to make work? So that's a long-winded way of saying in some of those markets, I'm not necessarily concerned about labor. I think it's there.
Anyone else?
No, I would just agree with that. You know, we have a spec building that's going up right now in Mundelein, and, you know, we're seeing pulling actually from, you know, west of there as opposed to, you know, competing with, you know, say the buildings of Gurnee and Waukegan, where, you know, you would think people would be more interested in being close to, you know, 94 and whatnot, but it's, you know, out, you know, call it northwest suburbs. You know, there's a lot of population out there, and there's people that, you know, live out there that they don't want to drive, you know, 30 minutes east to get to, you know, Gurnee or whatnot to work.
So is there a top 3, top 4, top 5 checklist of things that you can look at a site quickly and make some determination whether it's something you want a little more information on? Would you share 2 or 3 or 4 of those?
I think, you know, for us, we're looking at stormwater ordinances, we're looking at wetlands, we're looking at all the big flags that you can kind of pull just from national inventories and using that as a basis. And then a lot of it's just experience in the local market and knowing different areas are known for different geotechnical subgrades and challenges. And, you know, if you're in the city of Chicago, you know, there's gonna be some challenges with the redevelopment and just applying that to your best, you know, first guess of what things might cost to redevelop and putting it through the formula and putting it through the math.
I still think location's the biggest driver. You know, as much as we can talk about, you know, being out west or whatnot and wanting, you know, at the end of the day, you know, there's more population closer into the city. You know, what we have found and prefer, I would say, is, you know, being in DuPage County is, you know, as close in as you can be, whether that's, you know, the O'Hare market, I think is a great market right now if you could find something, and that's the challenge. You know, central DuPage, I really think is taking off and is going to continue to take off. That's becoming tighter and tighter. You know, as you see people start to build, you know, buildings in Winfield, you know, I think that's, and, you know, trying to pull from that central DuPage market, I think that's a good indicator if you can find something close to 355. You know, similar story with, you know, something in Lombard, you're starting to see some spec buildings go up there that, you know, haven't in, you know, previous years. I still think that's the biggest driver. And, you know, I do think part of that too is depending on what your capital structure is your residual cap rate. And I think you can get institutions and on the back end to, you know, be a little bit more aggressive on pricing, whether that's because they're underwriting a higher rent growth or whatnot on a go forward basis. But it always helps your numbers work when you can underwrite selling for a 5 as opposed to a 5.5 cap.
Back to some of the scarcity items. We covered precast, we covered steel, we covered land just now. And we talked about some labor. What about subcontractors? Are they plentiful? Are they around? Is there something that you all are doing different in terms, so you're pre-buying, potentially you said you're pre-buying steel, right? You're making a down payment on that to get your place in line. Same as probably happened with precast. My guess is with PVC and all these other things that are scarce. From a subcontractor standpoint, Chicago is known as labor all over the place and great subcontractors. Any sense of that in terms of, supply demand?
Yeah, it's been interesting. Honestly, my answer is I think there's capacity from these subcontractors, and it's an interesting dichotomy that you're having these conversations with precasters and you're having these conversations with steel manufacturers. And you have lead times out to January, and then I think you have a really hungry subcontractor base, and I think that's a function of some of the other product types having some slowness to their development. And a lot of these folks are doing, the electricians aren't only doing industrial buildings. So I think those electricians have capacity to do more in our sector because they're doing less elsewhere. So I think we've seen, other than the steel and the precast, we don't have a lot of concerns today.
I'm glad I'm doing an industrial panel, because if it was retail, I got no interest in retail whatsoever, right? So I can be very myopic. So that's a great point. Appreciate you making that.
And I was just going to add, we talked about the lead times for steel, but just to put the context of the pricing, we usually pay 70 to 75 cents for joists and girders and $1 for deck. And today we're paying $1.50 to $1.70 for joists and girders a pound, and $2.75 to $3 a square foot for deck. So it's almost $5 to $6 a square foot on the building just from the joist, girders, and deck manufacturers. And it's not all them, right? It's the supply chain beneath them. It's supply and demand and having to work a ton of overtime and their labor going up. They're actually not able to load specify all their designs. So they're oversizing their joists to keep up with production. So it's another kind of perfect storm of events. And then ultimately, I think it is supply and demand. But that magnitude of price cost, and I think you talked about deposits, and I think we're actually fortunate that it's not as bad here as it is elsewhere. Somewhere on the coast in the Northeast, a lot of these folks are instituting a 15 to 20% deposit policy, which when you couple that with a 35-week lead time makes a spec'd out development really challenging. Because when you're 30 or 35 weeks out from needing your steel, you're not under contract on the land, and it makes it really challenging to put that order of magnitude of dollars down. So in some ways, we're fortunate here in Chicago that we can work with these folks and allot our slots.
Yeah, the decision-making process has to be much more intense there, because you're outlaying 3 years in advance for the stuff, right? It's crazy. All right. Anybody else? Any comment there? All right. So staying with the land theme here is from scarcity and infill. There's a couple other product types I wanted just, if we don't mind, to cover. Cold storage seems to be really popular. And that may be counterproductive to us that haven't been to a restaurant in, I don't know, forever. Can we talk about cold storage for a second as it relates to a product type and how you see that? It seems like it's kind of exploded around in our market here in the last 2-3 years.
Yeah, sure. And I think it comes back to the supply chain again, and there's a new direct to consumer market for cold storage. Whether that's Whole Foods or whoever, but then also inventory. And I've been talking to capital partners that are asking, well, why aren't you? Let's do a spec building. And I think that would have been
sure. I'll start tomorrow. No problem.
That would have been shameful to even think of a number of years ago. But I mean, those thoughts are coming up because our clients are starting to think about rolling out national expansion programs to deal with the need for square footage, whether that's a PepsiCo or Frito-Lay or any of these folks are starting to think that way. So I think it's coming even more so than what we've seen. You have to have the land and be ready to move on it.
All right. So you think it's coming? Are you anticipating some percentage of growth or?
Yeah, I don't know for sure. My gut is kind of telling me you're probably, from what we've been seeing, probably in 25 to 30% growth in the next 12 to 24 months.
And is location more critical for that product type than something else?
Yeah, in my opinion, it's just as critical.
Just as.
Yeah.
Right, cool.
Yeah, I read an article that Warren Malcolm put out that I thought was interesting. They said online grocery shopping was up 40% this past year, and that the average cold storage building was 34 years old. So it's another combination of a lot of pressure on the supply chain, along with a supply chain that was somewhat outdated, that's creating a huge pent up demand throughout the market.
That's an amazing stat. Average age 34 years. Nope, totally get it now. Makes a lot of sense. Anybody else? All right. What about vertical industrial? Because we seem to be, everything in Chicagoland is infill. We haven't seen, I don't think we've seen any vertical industrial construction development here in Chicago. I know that it's happened in Seattle and it's happened in up and down the coast, I believe. Share any light on that for us, please?
Well, we talked about scarcity of land, and if we're talking a final mile type of facility that 150,000 square feet demands almost 35 acres worth of land to build that, and where these vertical projects can maybe get it done in 5 to 6 acres. I know a few clients of ours are already building design prototypes for this type of facility. Now, what the balance there is cost and operational functionality. You're adding a lot of twists and turns to your operations. You're going multi-level as opposed to just one level, and the cost is significant. You're now have structured parking that is a part of your warehouse square foot cost.
So literally twists and turns to get the trucks up and down, right?
Yeah. So I think there's an opportunity there. I think it's a logical step. It's wrapping your head around cost and logistics.
Well, you mentioned going vertical, and I think certainly multi-story warehousing, we're seeing a lot on the coast. I think locally, you talked about clear height. I think like anything, I think there's just been gasoline poured on a lot of the change that's happening. So it's not anything we haven't been talking about, right? The trend from 32 to 36 to 40. And I think now what we're seeing is there's new fire protection heads that actually allow you to go over 40. And certainly that's true in the cold storage market. I think we're seeing clear heights 50, 55 feet as people are looking at maybe going spec just to create as much vertical storage as possible.
Yeah, I guess I'm a little skeptical as to whether or not we'll ever see it in Chicago in any big kind of way. Land pricing in Chicago relative to where we've seen it in other markets on the coast just isn't quite there. From what I've gathered, it seems like land pricing needs to be in the 80 to $100 a foot for it to start to potentially make sense. And maybe there's some parts in Chicago near North Side, perhaps, where the land pricing starts to get there. You're close to a bunch of rooftops at the same time, but so maybe there's an opportunity, but I do think it is limited in Chicago at this point in time.
Okay. Anyone else? So let's move into costs, rent growth and returns on that. The previous panel had covered some of this. I'd like to get into maybe some of the submarkets in terms of where you're seeing a little bit more growth than in other places. Kyle, you said O'Hare for sure. Obviously, we just closed a huge deal up there. That quite honestly, if it wasn't for COVID, everybody was at home, that deal never would have happened, right? Because they were all in one place. We didn't have to go 4 different places to try to get a signature on something. Our team worked extremely hard on that. But that's two things, COVID, and they were home, and 2, it was sitting right in the middle of the oasis, right? So it was perfect. So could I get your input, please, on some of the other submarkets where you're seeing it, where you're looking potentially, and relate that to, my guess is that you can relate it because you're going there because there is rent growth there. So if that's not true, then tell us that, please.
No, I think, part of this, similar idea I had earlier, and, continue to think that O'Hare, Central DuPage, Western suburbs. I also think, north, whether it's North Cook County, I think being being in Cook County has value, especially if you're close into the city. But you want to be, I think, the north suburbs, just as far as highway access go. It's hard to distribute there based on being able to get east to west not very easily. I think people find a lot of value in being in a Niles or and then also just as you go further east, industrial's not getting built in Winnetka, Wilmette, Evanston type area. So people, lots of income there. People want to be able to distribute quickly to those rooftops and whatnot.
And so Niles, great case study there, right? There's been more industrial development there than I could ever imagine. And that's part of my being too old probably, but why did that happen there? Why is that happening there specifically?
My perspective is I think it's as far east as you can get and be able to access those. It's all about rooftops and being able to get to those rooftops. I think O'Hare has a great dynamic, and it'll only continue with the Western bypass is having access to 90, 94, 290, 88 sort of all come together there. But as far as access goes, getting east from O'Hare, it's not very easy. And I think Niles gets you to the east side of O'Hare and allows you to distribute east. I think if you look at those tenants that are there, we've got a building, in Chicago on the north side there, close into Niles, north side of Chicago, and our tenants there are a medical pharmacy tenant where they have physicians who are doing home visits, and they need to be able to get to the Evanstons and the Wilmettes of the world. There's a wedding designer in florist who meets with all those high profile high income earners, and they're coming down from whether it's Kenilworth, Winnetka, whatnot, to meet, as well as Lincoln Park area and whatnot. So you see tenants that are there that need to be there because of the location and proximity that they serve.
Thanks. Anybody else as it relates to submarkets and places that you're more attuned to than others? No? All right. What about, are there, so we talked briefly about environmental and political barriers. Grade those overall, not overcomable, you're fine, no big deal, don't want them to know.
I'd say a lot of the political barriers are generally overcomable, and if they're not, that may not necessarily be somewhere you want to develop anyways. On the environmental side, one thing that we saw as a result in the previous administration was some relief on what's considered jurisdictional waters, and in some ways that's been, well, in a lot of ways, it's been very beneficial in some of the markets that we work in. That could change in the new administration, so that's it. Remains to be seen.
I would say I think 6Bs have a very negative connotation in the public's eye. I think those are going to become harder and harder to obtain. And then also as far as right now, in Des Plaines, you got a 6B, you have to use all union labor to complete the work, and you start looking at some of the numbers on that, and the additional costs if you're looking at a $10 to $15 a foot build out just to get your 6B, and what you get for that, is some of the, things you have to check off. It becomes tougher and tougher.
So in the brokerage business, we haven't seen this kind of tenant velocity in a really long time. Maybe have never seen it to this level, right? So is it a matter of build it and they will come, or do you need to take it to where you think the tenants need to be? So Kyle, you just had mentioned the Niles market, for example, that obviously has got some metrics to it that is working. So in your jobs, how are you looking at that? Can you just build it anywhere and they'll come, or do you need to try to be a little more strategic with that? And relate that to the scarcity of land and the infill thing that, seems to be prevalent.
Yeah, so I think, just an interesting development over the last 12 months has been, the 1 million square foot warehouse in Chicago. We built a 1 million square foot spec building down in Shanahan in probably end of 2017. Our thesis there was, at the time, nothing had really been built over in the largest tenant you saw. And we got a few RFPs for the 700,000 square foot range. And we always felt like you know, it's a big box market there in Joliet. You know, you have the intermodal, you have so many different dynamics. You know, and you know, you look at some of the surrounding, whether it's a Columbus or an Indianapolis, you know, there's 1 million square foot warehouses there. So the concept wasn't out of left field. At the time, every tenant just found it cheaper, honestly, to go lease that location there. And this is a regional hub. It's not servicing that 1 million square foot building is not servicing just Chicago. It's servicing, you know, surrounding states as well. But, you know, we felt like where, you know, you have 80 running east-west and getting to a lot of those surrounding states, the location made a lot of sense. And we, you know, chose to be west of the intermodal there. So you weren't dealing with a lot of the traffic that, you know, has started to build up over time, and the building sat for 2 years. And then in a span of 6 months, you know, we leased 3 million-square-foot buildings there. You know, we leased the spec. First, we leased a, you know, built to suit to Amazon, and then the spec building. And then, you know, before we could even go vertical on the second spec building, that leased as well in November. So, and now you see, you know, CenterPoint just announced a month ago that they're building, you know, 2 more 1 million-square-footers after they just leased their 1 million-square-foot one as well. So, I don't know if that directly answers your question, but it's just, you know, something to note.
Well, so age has some benefits. 80 was never going to be an infill corridor, right? And because there was just so much land from sea to shining sea, the interstate runs from one coast to the other, right? So 55, on the other hand, was a spec development controlled by you guys, right? Because it was a finite amount of land, but where 80 was concerned, well, you can go anywhere. So to see those 8 buildings go up within 2 years, thinking, oh my God, but y'all were pioneers, and here we are now 2 years later, and they're leased. It's filled. So
It's hard to find land down there now too.
exactly. So, you know, the dynamic, just because you think something is true today doesn't mean it's gonna be true tomorrow. And you guys are on the leading edge of that. So I asked you what changed in your business as a result of COVID. Is this part of what's happened, is that there's this, you're expanding your view, and I'm not trying to be critical, but we can sometimes be myopic, certainly, and how we're looking at where we go, how we do it, and what needs to go there. So tell me about some of the particular change that you all have decided, like you pioneered out in 80, Kyle, it worked. Anyone like to participate in that question?
Well, as I mentioned a little bit earlier, is that expanded view out to areas that, you know, the secondary, tertiary markets that have access. There's markets that are right on 80, right next to 39. I mean, these are areas that, you know, I don't think we normally looked at, but the access is there. You can go north, south, you can go east and west. And our clients, that is what they're looking for. I want to get onto a major artery as quickly as possible and be efficient with our time. And so when we're looking at land opportunities, that's one of the first things that I'm thinking of, is how quickly can I get on a freeway?
Yeah, I was gonna say, you know, as a contractor, I'm not naive enough to think that like we're leading tenants to where they want to be. I think we're following our customers, and our customers are following the tenants to an extent. We were the first shovel in the ground in Maryville. You heard in the previous panel, they mentioned that park is filling up quickly. I think they're going to fill up this year. We just broke ground in September. So certainly I think there are tenants that have their own objectives and they want to go where they want to go. And I think we're going to follow where they want to go.
I would say too, what used to be considered bulk at, you know, 750 and now maybe $1 million, it seems to have been trended up yet again, and $1 million almost isn't even big enough. So, I mean, to be able to find land tracts that can accommodate $1 million expandable, you know, up to $1.5 million or even more, seems to be, you know, more and more of something to look for, because those requirements truly have been there.
All right, Ben, thanks very much. I'm gonna just open this up for a few minutes for questions. So if anybody would like to ask a question, please feel free. Yes, sir.
Yeah, so for those that didn't hear, I think the question is kind of when will the supply and demand curve for steel start to relax? Obviously, I'm not a tea leaf reader. I think the best example I can think of is when the tariffs first came into effect I think that was 3 or 4 years ago. And we trusted and listened to some of our suppliers. I think they thought it would take a year or two for things to relax. And to give you some context, I talked about 2 or 3 times multiples in the cost this cycle. I think we were at like a 50% premium back then. And I think we figured that out in 6 to 9 months. The mills opened up additional capacity that hadn't been open for years. And, you know, they're working overtime. They're filling that supply the best they can. I think this one feels different. The order of magnitude is drastically different. And I think what we're hearing from our suppliers is to expect this to last 2 or 3 years. I hope it doesn't stay at this peak level for 2 or 3 years. I think the one thing that we feel better about, you know, the run that we've been on these first 4 or 5 months has been pretty extreme. We've been talking about steel every day. At least I have been for 4 months. And every day it felt like it was getting worse and worse. We thought it was really, really intense when it was a 50% premium, then it was 100, then it was 150, then it was 200. But I think we're at a point where we've tested kind of what you could build a building out of cross laminated timber or hollow core, you know, precast trusses. And we're about at the point where, you know, there's kind of an artificial ceiling, so to speak. So I think we don't think it's going to get worse, but we don't also think it's going to relax anytime immediately in the future, just based on the pent up demand continuing. And that we're already out to January of next year. There's not a lot of hope that next year in the spring is going to be immediately better.
All right, 1 or 2 more. Yes, sir. So, yeah, so he asked is if I-57 corridor further south is a viable new frontier for y'all.
I think it's something that, you know, I know you mentioned, you know, we built our building there. You know, I think it's a great big box market. As you mentioned, it's cost effective. You know, land's cheap there. As you see, I think Joliet and I-80 continue to tighten and, you know, whether you start having the conversation, if you go further south down 55 to find your, you know, building, or you go out west, you know, out I-80, or do you look somewhere like a Moni? You know, I do think it has potential going forward.
Yeah, and what we said a little bit earlier is these buildings are not getting smaller necessarily, they're getting bigger. So you need the land in order to do that. So it's logical that that's going to be definitely a location that we look at, as well as these other, you know, tertiary markets.
All right, 1 more. Yes, sir. So the question was, is trucking moving in the same direction as automobiles from gas to electric or some other form of other than gas?
Not that I've seen yet.
I haven't seen it in RFPs or proposals.
All right, thanks, everybody. Appreciate it very much.
You want to reach Adam Roth at NAI Hiffman. I believe he's still with NAI Hiffman. Adam Roth. That's your expert when it comes to trans and logistics regarding practical autonomy and driving and all that good stuff, trucking. All right, we're going to take about a 5-10 minute break. And then we're going to get into the investing solutions, financing the solutions. So let's be mindful, we're moving it along. About 5-10 minute break, please. Adam Roth is by far my foremost sections for what comes to transit logistics on trucking, practical autonomy, costs, oil costs, impact. I give you this information, please, have it wrong. Can't make it out. Can't make it out. Where's my mask now? Well, I don't know where. They're all here. Thanks, Dan. Thanks, Dan. Good to see you. Thank you very much. Anything you need, let us know. Hi. Yeah, John, give it about 5 minutes. I'm Ernie Abood with Real Estate Journals. Nice to meet you. Who are you with?
I'm with O'Keefe.
Okay, sure.
I
John.
got two of the guys on the panel out there. I gotta find the watch the last one.
Yeah, I'll make an announcement shortly. Ernie, and John, yeah.
Excuse me, Ernie.
Okay,
Thanks.
thanks, you bet, always. Keep rocking. That's what we're looking for? John Joyce and Pete Corrigan, are you here? Has anyone seen them? All right, let's take our seats, folks. Here we go. Good to see you, Alfredo. Good to see you, sir. Thanks for lunch. Sure, absolutely.
Alfredo, John Joyce. Good to see you. How are you?
Ernie.
Hey, Ernie, Hugh Williams.
Nice to meet you. I gotta look at it.
I like this. MK asset man.
Great.
Yeah, that is that.
And I think we're all here, right? John? Yeah, we're all here?
This isn't working though.
You have a bad, was this a great button?
Test.
Hello, hello, hello.
Yep. Hello.
Here. All right.
Hello? Hello? I think we'll get started in a minute. I think people are still coming in.
All right, let's take our seats, folks, in the back room, grab a refreshment. Let's sit down. We're going to proceed with the program, talking about some investing solutions, financing. We have some top speakers here. Let's get into it. Thank you.
All right, I think we'll get started. Morning, everybody. My name is John Nye. I'm a partner at the law firm of Keefe, Lyons and Hines. We focus on commercial real estate taxes. It's good to be among you. Have some positive things to talk to other than property tax. So I don't want to be a bit of a mood killer here. I'm just going to moderate. I'm glad to be part of the program today and to be involved in discussion on investing with industrial real estate. Also taking part in this discussion is a group of professionals who are actively involved as owners, investors, as well as brokers, advising buyers, both buyers and sellers. We have about 45 minutes for a panel discussion. We're going to devote some time near the end of the program for questions from the audience, as well as those who are joining remotely, I believe, if we've got that the capability. Sure. Can everybody hear me? Okay. To start the program, each of the panelists will briefly introduce themselves as part of answering our sort of icebreaker questions. So the first question I have is, what trend or issues in the industrial market is most on your mind as we merge into 2021 and now roughly 1/3 of the way through the year? And I'll start with Hugh.
Oh, perfect. Hey, Hugh Williams with MK Asset Management. We are a small group, a group of brokers kind of focused in the industrial space. And then we also own an eclectic portfolio of real estate, heavily weighted towards industrial between Atlanta and Chicago at the moment. We do a little bit of development as well. So in terms of the things that I find most interesting right now, you know, from a brokerage perspective, we just recently completed deals in Riverside, California, Salt Lake City, Utah, and we're out to lease in Savannah, Georgia right now. And those markets are either coastal markets or close to coastal type markets. So I think it's really interesting, just the pressure that you're seeing from markets that are close to the coast. So, which is, you know, the Midwest, so we're an internal port of sorts, but that's just been something that's been top of mind for me.
Why don't we throw it to Alfredo?
Good afternoon. I appreciate everybody being out here this morning and those that are online. We just so you know, we divided up the ties versus the no ties. So at the end of this, you're going to have to vote.
Looking for trends.
There you go.
I'm just happy I can still get my tie. So.
Anyhow, good afternoon. My name's Alfredo Gutierrez. I'm the founder of a industrial real estate investment, merchant investment firm out of Houston, Texas. We have been in the business for a number of years. We have product here in Chicago and throughout some of the secondary cities throughout the Midwest. And again, we specifically only invest in industrial product. What has been on my mind of late really is the changing landscape that has been occurring. Traditionally, we are an entrepreneurial firm that has access to institutional capital. So we were able to play in a sliver of the industry that we could go out and find assets that are somewhere between, you know, $15 and $25 million. The large institutions weren't coming down into that arena, and the smaller local money was not coming up to that arena. But what we have seen is a lot of new players that are coming out of office and retail and some of the other food groups that are coming to industrial because of all the good press we're getting. And we're seeing the ability of these local investors, the high net worth individuals, being able to aggregate funds through crowdfunding or, you know, managers, family fund managers, starting to move into the larger food groups size-wise. And we're also seeing pressure being put on a lot of the institutions that they are now bidding on a single asset by itself just to continue to grow their portfolio. So there's a lot of competition in what I do right now. And, you know, as well as throughout the thing, you know, with cap rates compressing. So it's kind of what has been on my mind a lot, because it's a challenge to continue to find good assets at good pricing.
Thanks, Alfredo. Pete, that's you.
Yeah, absolutely. Hi, everybody. I'm Peter Doty. I'm a senior associate at Marcus and Millichap in our downtown Chicago location. I lead a team, a brokerage team that we specialize solely in the disposition of industrial investment product. So don't focus on leasing management. Our time is solely focused on, again, disposition of industrial product. Most of my insights will come from the private capital airspace. So call it the $1 to $20 million airspace. We work with a lot of high net worth individuals, LLCs, family money, private partnerships, things like that. And as far as insights for what's been on top of mind with myself and my clients lately, which I think that we're going to get into here in a bit, but definitely being cap rate compression, obviously going on in the nation as a whole, but in Chicagoland specifically as well. And then also just the ability to find opportunities. I feel like in the private capital airspace in that $1 to $20 million tranche, specifically more even in the $1 to $10 million tranche for industrial product, demand is extremely high right now. And at least over the last 6 months, it has been a very, very dry market where people have funds or capital that they're looking to put to work and are just really struggling to find good opportunities. And that comes from a standpoint of demand, where cap rates are compressing and people are not happy with the returns they could have gotten, 12 to 24 months ago. And then just more location specific as well. So those are some trends I'm really seeing or talking almost on a daily basis with my clients.
Thanks, Pete. John?
I'm John Joyce. I'm a CCIM. I've been in the business for about 27 years. Operate SVN Chicago Industrial in Rosemont. Have 10 advisors, and I have my own account of a portfolio that I manage, maintain, operate. And what's on my mind is I sat on this panel last year, and I made a forecast that last year would be the best year of all time. And I was going through the year, scratching my head and saying, why did I say that? And for some reason, it ended up being the best year of all time for reasons we couldn't perceive. So it's the best of the best, but that can't last forever. So, we're going to talk about the fundamentals and what we see here, but we should also be cautious that this run will end at some point.
All right, thank you. We have a I have a number of questions I was going to throw out to the panel, and the format that I thought we would follow is I'll put out the question and direct it to one of our panelists, and then the rest of you guys can jump in and discuss the matter. The first question we have is following up on what Pete said. One of the true barometers of the strength of the market is continued compression of cap rates. How long do you see that continuing, and what can owners do to ensure its continuation? Pete?
Yeah, like I mentioned previously, cap rate compression for industrial product is on the top of everybody's minds right now, especially in the Midwest, where I know it was mentioned earlier today, where people typically come to get yield from the coasts, where you see on the coast typically it's not foreign that out there you're going to pay, in at least the private capital space, 5 to 6 caps, where here people are used to getting call it 8, 9, 10 caps. But that's not the case here today. So with my clients, I like to try to stay, fact-based as much as I can. Where we're at today, cap rate compression in Chicagoland is at historic lows, at least for our Marcus and Millichap information. Over coming in at the end of 2020, starting in 2021. Again, this is a large spectrum taking into all accounts of all product type, from your Class A Amazon warehouse to your smaller, $500,000, $600,000 deal. The median ended up being a cap rate of just shy of about 7%, right around a 6.9%, which is an all-time low for Chicagoland. So that obviously, as far as moving forward, where do I think things are going to go? I wish I had a crystal ball. Unfortunately, I don't. In my opinion, I think it's obviously cap rate compression is not going to change. I think it's for the foreseeable future, call it the next couple of years, is going to continue to compress. I think it's just a matter of how much and how fast. So that's really some kind of, insights. And again, conversations I'm having with both owners and investors every single day.
I don't know if anybody else wants to jump in.
Well, I would agree with a lot of what you're saying. I think there's also a fact, and if you compare what's been going on in this pandemic environment to a little bit of what occurred in 2008, and anytime the government pushes money out the door with stimulus, it's got to pop out somewhere. And you're seeing a little bit of inflation finally in the commodity side of things. Going out to goods the way they measure inflation, but there's tremendous asset inflation, and there's tremendous asset inflation again today with all the money that's flooding out there. And so industrial real estate, as well as all other real estate, is getting awfully expensive. So I do think cap rates will continue to compress just because if you compare it to some of the other investment grades, junk bonds are trading at 2.5. That's for junk bond. I'd much rather own a piece of real estate that's yielding, a low single digit in a good location. So there's justification for it, for those cap rates to be down there. I think rates are going to stay low for a period of time. When you saw us coming out of the financial crisis, it was about 7 years before the Fed started to move the rate again. So I don't think it'll be 7 years again, but I think it will stay in a low interest rate environment. The spread is there. And anytime you're having an inflation in the commodity, especially still as was discussed earlier this morning, you got to have it pop somewhere. So it's going to pop in rents, but it can't all occur in rents. So it's got to be cap rate compression because the asset value is going up.
So I'm just curious, this panel focuses on industrial property, but is there any would you prefer to be in a compressing cap rate with this class of property, or how are, let's say, office buildings or other commercial properties doing comparatively?
Well, I'm an industrial guy, so
Sure. Well, then you'd rather be in the industrial market,
obviously industrial, only because we're not smart enough to do office and those other product types, But I think there is fewer moving parts in industrial versus some of the other food groups. So it's easier to analyze and isolate,
mitigate your risk
as things change.
Sure.
So I would always prefer to be an industrial because of that reason alone, especially in changing times.
just want to jump in here. So we're seeing people come from other asset classes into industrial and other businesses into industrial. So been very fortunate to be part of about $12 million in investment sales so far this year, about 15 million under contract. And only on one of those projects was I on the sell side, all on the buyer side. And I think it will continue to compress, and people from, you know, the A asset class are a lot different than what we're looking at B and B minus projects. And there's just not enough supply, and people aren't building those types of properties anymore because of construction costs and commodity jumps. So that's what I'm seeing.
I'm going to segue into the next question. It sort of follows up, I think, what John's talking about with so much capital chasing Class A space and newly developed buildings. How's the market for Class B properties, those that may have a little age to them? And I'll throw that to Hugh. Why don't you take that?
All right. Hello? Okay, perfect. So actually, this answer is going to piggyback a little bit of what Alfredo said. We're looking at an asset in Kansas City right now that's a Class B industrial portfolio, you know, a few 100,000 square feet on the acquisition side, and 126 people signed the confidentiality agreement, and the group that's selling it expects to get 10 to 12 offers, right? And this is Kansas City, which is not Chicago, and it's not Houston. And I know that there's rail that, you know, is going south to Mexico and up to Canada. But, you know, for guys like us, and we own 700,000 square feet of that product in Atlanta and a couple 100,000 square feet of that here in Chicago, we can't compete and we can't chase that product anymore because the unusual suspects are now, you know, swimming in our pool for that product type. So we're seeing institutions, and the broker who's selling is actually a good friend of mine, and he said, hey, everyone is chasing yield, everyone. And so unless you're willing to, you know, really pay for this, then I wouldn't waste your time. And that's probably going to trade at call it low sixes for Kansas City for partially leased, few 100,000 square feet of flex type product. And the rents are, there's a little bit of room in the rents, but there's probably 20% or 10% of that rental rate that is could be attributed towards some deferred maintenance on that asset. So we can't win. So there's a real pressure in that product. But you know, also, just like Alfredo said, we were looking at a building in Savannah, which was a Class A building, but 7-year lease, 325,000 square feet, about 30,000 square feet of office, which is a lot of office for that type of building, and a good tenant, but not a great tenant, but that'll trade at a 5.25, right? And that's Savannah, Georgia. So it's just hard. And the way that we're finding deals is we got to knock on doors and hope that person hasn't been reading the paper.
Well, at least now I know who two of the guys at Pull Packages are.
That's right.
Yeah, but I think a lot of it is, you know, as there's been a challenge, you know, we've all been talking about cap rates are compressing, yields are going down. So, you know, as investors, we're all trying to preserve our cash on cash, our yields. And so in order to do that, you've got to step out a little bit on your risk tolerance. And in order to get the returns that you think you should be getting and what you've advertised to your investors. And so what that means is the individual that may have only been playing an A product is going to move to B to pick up that spread, or the player that's only been in the regional hubs decides, you know what, I need to move out of Chicago and get into Kansas City or St. Louis or one of the other markets that I can pick up that spread. So they're moving their risk tolerance a little bit in order to chase the yield. Is that a bad thing? I don't know, but that's part of it. And so anytime you have supply and demand, just basic economics is going to tell you that that product is also now going to start compressing in secondary cities, and the B product and the gap between the A and the B and the first tier and second tier cities is going to compress, and that the gap between the secondary and the tertiary markets is going to compress. I think that's a lot of what's going on, is just really chasing the spreads in order to get the yields that you want to get.
Okay, you guys have any comments on that, or we move along if you want?
Yeah, I can make a quick comment on it from the brokerage side. I'm seeing that a lot as well, even taking it one step further from the from the A to B to B to C as well, even moving into some smaller assets like call it the 50 to 100,000 square foot tranche. People chasing yield, also looking for opportunities where, and investing is all in the eye of the beholder, right? So I work both single and multi-tenant. I work with people who, they want the big box precast warehouse with, 12 or 15 docks with the publicly traded tenant and on a longer term, triple net lease, and they're willing to pay a, 5.5 to 6.5 cap for it. Whereas I just sold a deal in about a $4 million deal in Lake Zurich, Illinois. It was multi-tenant flex industrial warehouse, had about 10 tenants, a lot of moving parts, a mix of mom and pop tenants. The anchor tenant was a publicly traded company, but the investor, who actually was a multifamily investor who was in a 1031 exchange looking for yield, like the fundamentals of the deal, like that there was multi-tenant, so he wasn't putting all his eggs in one basket, and just thought that the kind of incubator style space for the type of user that is maybe not looking for the 40-foot clear, but only needs the 16 to 18. Maybe it is a mom and pop, maybe it is a a more regional credit type where they just need a drive-in door for box trucks, things of that nature. You're always going to, the tenant profile that lends itself to a lot of people where you're always going to be able to backfill that as well. So not only risk from moving to different parts of the country, but also risk in the type of building you're investing in as well.
I'm gonna throw you, we'll get off this just a little bit. We've seen to spend a little time on the A and B buildings. Hypothetical, John, if you could acquire or have a listing to sell one building in this market, would you prefer newly constructed but vacant high cube facility, or a modern cold storage facility, last mile facility, or core asset with small amount of term left? Which would you choose and why?
Well, when you say last mile, it's hard to describe what that means. I think of Amazon, that they have all the last mile facilities. Maybe Lincoln Property Company has a 138,000 square foot building at 3711 South Ashland. That's probably the last mile facility.
So a little up the road, I guess.
Yeah. So I'd probably take core asset location. Well located assets are always going to be in play, in demand. They're going to lease up with the short term left on the lease. You could get a quality tenant. Investors are paying really, really outrageous numbers. I know that Amazon building on Woodlawn in Chicago, the Ryan Companies sold for $65 million or $450 a foot, a 4.25 cap rate. So if I could get a listing, it would probably be, that location.
Anybody else of that?
I agree.
Okay.
I think so much of it, is really the basis in what's going on there. So, there's good assets in every market in Chicago. It's what you're willing to pay for that and what your yield's got to be. And there's good assets in secondary, tertiary markets. So, it's really going to depend. I do think that the refrigerated space is a sector that's going to be growing. I think you're going to see a lot more of that product coming on ground. But it's also a very, very expensive product. And it's only going to be a certain group of developers that are willing to take that risk at those kind of dollars to do that. But that's, if you're crystal balling what's going on out there and where there's the demand, that's it. But I think there's only a few people that are going to step up at those kind of numbers and put that on the ground.
And with that kind of cold storage development, are there certain sectors of the country or markets that there's clearly still a need, or are they driving?
Well, I would say that there's, if you just take a look at the entire cold chain throughout the US, I mean, it's like infrastructure in the US, right? The majority of the infrastructure in the US was built in the New Deal as a function of, economic stimulus, right? And so that's why every road and every bridge in America is fallen apart. And then it's sort of the same with the cold chain, the Google facility in the city of Chicago. All of these are old. What's happened in the West Loop is a lot of all those buildings have been raised. That cold chain's got to go somewhere. And so I think that it's really all over the country. I hate to harp on Kansas City, but we did a 40,000 square foot freezer cooler deal here in Chicago. Same group is looking to expand in Kansas City. Can't find anything even remotely reasonable. I mean, the majority of this product is 1960s, 70 era product because they don't move, right? It's hard. It's a barrier. There's a high barrier to entry. So I think you're right that the developers who have the fortitude to build this kind of product speculatively because it's not cheap, I think they have a chance at really winning.
Yeah, I would say with regards to, my personal belief as well as what a lot of my clients are looking for in today's industrial market right now, as a hot commodity, kind of going off of what Alfredo said, is basis, right? So the reason that people in the first place were lending themselves or interested in industrial is the concept of it being vanilla, as it being replaceable. So you want to make sure that you buy the building or the bricks and sticks, if you will, correctly. Once you overpay for the building, depending on what's going on with the lease, you might not get that basis or that call it price per square foot for the building itself back. Whereas as long as you're buying the building correctly and the rents are replaceable, and the building lends itself to enough users that anybody, your tenant pool is very wide, then I'm okay with having the tenant in there that might have the, couple $1 million EBITDA. I don't have to have FedEx in there because if they were to leave, I know based on, if I bought it right, based on the basis and the location and the fundamentals, with vacancy and things like that, there's going to be demand for that space. Whereas compared on the flip side, if we're talking net lease industrial, say to, net lease retail, whereas if you're buying a Walgreens, that's a very special use building where, you might get the corporate guarantee and, you can absolute net, you can sleep for 23 hours a day if you want because they're on a 15-year lease. But if they were ever to leave, who do you backfill that with? Because it's a very special use, CVS maybe, but industrial, the fact that it is replaceable and things of that nature, a lot of the people that I'm working with are they're very, very focused on the building first and the lease second, making sure you're buying the real estate at the correct price before worrying about who's in there now or in the future.
Okay, thanks, Pete. Alfredo, I'll throw this question to you to start. Rest of you fellows can jump in. Alfredo, earlier this year, you were asked to predict whether Sparrow Hawk would be a net buyer or seller. Talk about where you are at this stage in the year and why your response may have been surprising.
Yeah, at this point of the year, we're still a net buyer, and we have some product under contract to sell, and we've closed some product in Kansas City. So we are, I think, a net buyer. And the reason I say we're a net buyer is every time I'm out there competing on deals and seeing where things are trading, it, puts a smile on my face because I go, wow, I wonder what my stuff's worth, so that's kind of awesome. But, at the end of the day, I realize that if we do push product out the door, it is an extreme challenge to redeploy those assets and find a replacement for that yield that we just gave up. So, I am a net buyer, but I'm also by nature a little bit of a contrarian, and the contrarian in me is screaming, sell, because, there's so many buyers out there. So it is a question that I think about every day. And at this point, still, it's let's be a net buyer. And I think there's some great assets out there to buy. I see some good fundamentals that are going on out there. And as long as the lenders don't screw this up and start lending way too much money, we're okay.
I'll weigh in. I think as investors, they always have to be looking at, is it time to buy, sell, or hold? And there's just so much demand in perceived inflation in the market that. Can you hear me?
I can hear you, but I'm standing right next to you, so.
Sorry. Okay, let me just try to remember my thought there. On the buy side, there's so much inflationary reasons to believe in building supply costs going up that that be a good time to buy. On the sell side, you'd be looking at what Alfredo was saying is I can get out of a position right now that I don't want to be partners with these people anymore, or whatever your case may be. You've met your objectives and exit strategy is there. And hold, I mean, the reason I think people buy a main reason to buy these types of assets is to build wealth for retirement. So holding is always a good idea for long-term planning. I'll work on my holding.
Hello.
Okay, so
I'll come back later.
okay, I have a question here just for the panel in general, and since it's where I sort of operate, I'm just kind of curious to know what you think. Results of many surveys show that the Chicago area and Cook County real estate taxes are one of the greatest threats to investing in Chicago real estate. Now, the Cook County assessors just finished the session of reassessing the southern part of the county, there's a lot of industrial property located there, and he's about to start the city of Chicago for 2021. So given the lower basis of industrial values, how much of a factor are real estate taxes for an investor in the industrial sector? Go ahead.
Let's just check this mic again. So my entire portfolio is in Cook County, and earlier today we were talking about rental growth. And from what I see, rents have grown in the O'Hare, Northwest Cook, North Cook areas by 15 to 20%, probably pushing 20% in the last 2 years. So I don't think the tax situation really matters. I've been in this business for 27 years, and all I've heard is last person out of Cook County turn off the lights. And that's just not happened from my perception. And the rent growth is outpacing the taxes. So
is that also in the southern part of the county, or?
Southern part of the county, taxes are starting to, you're making a good case there.
Right, because I'm just curious. I mean, we won't actually see that impact. I mean, the board review's finishing up and those 2020 values won't be certified. Those second installment bills will probably be late. So you're probably going to see bills October. And, you know, I guess we'll see how that impacts the South. And the city's up next. So, and this current assessor is, you know, was elected on a position that he felt that a lot of property in the county had been undervalued. And so he's certainly moving values up. I think it's probably much more noticeable in a commercial set, maybe not in the industrial set. But.
Yeah, I think that when your assessor is a star, everyone in this room probably knows his name and has heard his name a lot. That's never a great sign. But you know, the risk is this: if you're an investor, and let's say there's a 6B in place, then you look at the world that the taxes are a time bomb, right? Ticking time bomb, and you can't. Anyone who's going to buy this asset for you is going to devalue it. But we were selling.
You can always renew it. Usually,
you could. I mean,
most of those municipalities are supporting renewals. I haven't really run into anybody. Elk Grove years ago wouldn't, but
Franklin Park,
yeah.
You know. But so, but I would say this: people see what they want to see in any market, right? So if you look at Chicago's having the second or third largest industrial base throughout all of North America, right? People are going to still have to be in Cook County. That's just the facts, and what all markets are good at doing is sort of normalizing around whatever the current political environment is. So if anyone thinks I can tell you this, for years and years and years and years, just like what you said, last one out of Cook County, shut out the lights. But, you know, Wisconsin has grown, but it hasn't been because of, I'll give you an example. We work closely with a firm that's in Cook County, 250 employees. He said, Hugh, you know, I get a phone call every day from North Carolina and Texas about relocating to North Carolina and Texas. The taxes suck. People, I try to recruit people, and people say that they think they're going to get shot. This is in, you know, suburban Cook County, by the way, because it's Chicago. And then in the next breath, he says, but I can't leave. I got too much infrastructure here. My talent is here. And if I were to leave, my business might die. So that's the reality. We're just going to work around it.
And you have the population here still, even though it's a decreasing population, you have the population. And so, as I said earlier on one of the panels, when 6 million people disappear from Chicago land, then you got to worry about that to some degree.
I was just going to say there are about 290,000 people leaving Illinois every year, but there's 250,000 people coming in. So we're losing about 40,000 a year, and they're highly educated, Big Ten schools, technology based. So it is a swirl, but I think we can overcome it.
And then just one last thing, John, when you talk about that net 40,000 people, one thing that we haven't touched on here today, but in terms of what we need to think about in the future is just the ability for people to attract employees and keep employees. So if you look at the real unemployment rate over the last 20 years, it's really not that different, but but this nature of the gig economy has changed the way people approach work. So employment's going to be a big issue, and where there's people, at least you got a shot at getting, workers.
And along those lines, I will say one thing Amazon does is they market themselves extremely well. And what Amazon has been doing lately is marketing their workers, and they're making them heroes out there. And I know all of y'all have probably seen the commercials of, celebrating the delivery driver, celebrating, I'm glad I work for Amazon because I can give back to my community. Amazon's doing a phenomenal job of branding the warehouse worker and the trucker and the delivery person as, hey, that's a kind of a cool job, and it pays okay. And so it's going to attract people where it was a challenge to find warehouse workers, because when I got started in the business, I'd go into some of these, especially some of these manufacturing facilities, and I was like, oh, it's pretty damn scary in here. I may lose a toe just walking through it, so it's different now, and it's attracting a better educated workforce, and the pay is starting to get to be where they can make a living doing this. But most of all, it's those commercials. It's making it cool. And I think there's folks flocking to it, and that's good for our industry.
Yeah, my thoughts from a brokerage side again. Obviously, I hear the idea of Cook County taxes every single day. It's interesting. To me, it's really split. It kind of just depends on who you're speaking to and what their personal objectives are within their portfolio of what they're looking to accomplish. Some people are very, very bullish on Cook County for reasons said, business fundamentals of Chicago are not going anywhere. There's always going to be a demand for space in Chicago, given the size that it just simply is. And then there's some people that Chicago is blacklisted. I have investors that call me, and I can tell them I have a 12 cap deal, and that's a great deal, can't miss deal. And they're like, if it's in Chicago, it's in Cook County, I don't care what it is, I won't look at it. So I think it really depends on what you're trying to achieve. Again, investing is all in the eye of the beholder. So it's kind of, it can be personal, but it is definitely something that people do take into consideration. And it's something that even by other parts of the country, it's the way people know Cook County. It comes up in conversation very, very fast.
Okay, we're about 35 minutes into it. I think we can certainly open it up to questions from the floor if we'd like. I don't know, Ernie, if we need a microphone to pass around, if they can just stand up and holler them out.
their question was how we addressing and assessing the creditworthiness of tenants, especially coming out of the pandemic. And I'll tell you what we're doing. And, you know, we're probably a little bit different than the larger institutions. You know, the one thing I've always said is I want to understand the story behind the tenant. Because there's some great companies out there. They may not be a Fortune 500, but I guarantee you they're going to pay their rent every month. And they're going to be good stewards of the real estate and good tenants. So, you know, credit sometimes is a little bit overrated because I've seen a lot of big companies disappear for whatever reason. I mean, one bad lawsuit and, you know, that company's gone, even though they're a Fortune 500. You know, Enron in my hometown of Houston, great example. Okay. So just because you're a phenomenal company doesn't mean you're going to pay rent through the whole duration of that lease term. But it's more important understanding why they're there and what's driving them there to that location. But to answer your question specifically, what are we doing? You know, I think the folks that have survived this 14 months, if they're in a sector that has strain on them, and Hughes and I were talking about it because he has put a tenant in one of our buildings.
He's not a liar.
Yeah.
So this was a true story.
You know, they have survived. They've got a great model. They've got great product. And they had some pain. And so we worked together to soften that blow, to make sure they come out on the other side. So I think the tenants that are out there right now have been proactive in doing whatever they need to do. Their financials may not look phenomenal. And I think, you know, we may need to figure out, okay, is it a burn off letter of credit? Maybe, possibly. But again, realizing you put a line of credit, letter of credit on them, you're putting some cost on top of them. So, you know, are you dumping, you know, soil onto it, or are you helping them out here? But if they're here and they have survived this 14-month, and especially if they're here and they survived the 14-month in a strenuous situation because their client base is a hospitality or something like that, and they've survived that, they're probably going to survive. They're good people.
And just to piggyback again, I love sitting next to Alfredo. When you mentioned the letter of credit issue, so there's what we've seen is a couple landlords now go straight to the letter of credit issue, go straight to letters of credit. They don't they don't accept security deposits anymore. And the reason being is, you know, in the chain of sort of title of getting someone's money in bankruptcy, the letter of credit is actually protected for the landlord. So I think we're seeing new approaches to securitizing that lease.
Lease guarantees.
Yeah, the only time I do it on lease guarantee is really for a new company, because they don't have the track record. Yeah, that's not to say that an existing tenant wouldn't come to me and it calls for it, but in general, a guarantee to me is, this is just my viewpoint of it. I have nothing to base my decision on, so I've got to get somebody to guarantee it that I can make a decision on and realize that they're going to survive. So to me, guarantees come up a lot more if it's a new company. I don't know what y'all are seeing.
The only thing I'm going to add is we do ask for guarantees on, you know, privately held companies, smaller companies. If they have something that doesn't add up on their financial statements, we always go and visit them at their current facility to see what's going on there. Are they bolting anything down at the new facility? Do they have costs, whether they're going to be embedded? And kind of figure out what their story is, what happened to them during the pandemic, and was there a nefarious activity with an employee, or did some customers stop paying? Sometimes there's a story behind it, and if it adds up, you know, maybe you do need a beefier letter of credit or security deposit.
Well, I'll ask a question here because
Go right ahead,
you
Alfredo.
mentioned it earlier. The 1031 exchanges. with a lot of stuff you're hearing out of Washington, with cap gains going up and, the fear of 1031s possibly going away. I personally do not think they're going to. I think cap gains are going to go up. What kind of impact are you seeing with clients coming out? I mean, or is this a topic with your investors? You had mentioned it earlier, potentially. Yes.
Yeah, the 1031 exchange is something that every election it's always a topic of conversation, right? It's definitely something that people are worried about, especially the fact that the election just happened. So there is a lot of uncertainty right now. I wish I had an answer. I don't. Unfortunately, like I said earlier, I don't have a crystal ball. My suggestion that I'm giving to my clients, for anybody that if 1031 exchanging is a part of their plan, whether it be, call it in the next 12 to 24 months, I'm suggesting that they at least get an analysis done to understand where their equity stands now and at least have a game plan in place to keep them in front of the market. Whereas, because, 6 months from now, it could be gone, right? So basically, not having an answer, my suggestion is just trying to stay proactive as possible, understand where your equity stands, understand where your returns are. Maybe not truly identify, but have an idea of, if I was going to do this, what am I going to look into? Which again is always a difficult conversation to have, because truly you can't, anything you identify now is probably not going to be there by the time you close, right? If it's a well-priced deal. There is unfortunately no concrete answer. I'm just advising people to just stay as proactive as they can. And as far as what the new legislation is going to do, we're going to have to wait and see. My personal opinion, I don't think it's going to go anywhere. Like I said, it comes up every 4 years or every election, but time will tell.
All right,
How about opportunity zones? Relevant to that, I mean, are you seeing any investments in opportunity zone areas? Are they non-strategic areas because of where they are? What's your commentary? What's the perception within regarding the investment in opportunity zones?
Sure. I mean, from a brokerage point of view, again, opportunity zones, there are groups that are specifically targeting opportunity zones that have capital allocated to go after deals there. Again, I would say I have not personally dealt with a lot of opportunity zone specific deals in the last, I'd say, probably 12 months or so, but there definitely are groups out there that are allocating funds towards those types of opportunities. I don't know if this is a fact or not. I feel like a lot of the people or other brokers in our office that I speak with that are working opportunity zone deals, a lot of times, for whatever reason, tend to be right now more on the multifamily side of things. Again, I don't know if that's a fact or a trend, but that's something that I've seen a lot of.
Here's what I think about opportunity zones. Number one, if you're going to spend some time in opportunity zones, look at a place like Crescent, a group that does it around the country, that's got real reach and a real, and number two, opportunity zones, the majority of these sites are in an opportunistic site type location. Construction costs are the same, regardless of whether or not you're building in River North or wherever this opportunity zone is. It's really a market-driven thing. I mean, so I think it sounds nice, but until the market grows to where these opportunity zones are, it's a lot of talk. Or put your money with a group that does it all around the country and has a opportunity to actually make good deals in that space.
I agree. I have not seen any deals perfect in opportunity zones. I've gone down the road and they're usually located in areas that they don't want to be in.
All right, well, we're almost at 45 minutes, so I'll just throw out one last question and work our way around the panel with it. What is the greatest challenge the market faces? One that can derail the industrial train at this point? And we'll start with John.
Well, if there's some new technology that we're not aware of right now that's going to decrease the demand for warehouse space and shipping times are just in time, that could be one. Hyperinflation, they're pumping in trillions of dollars into the economy. Interest rates have to go up at some point. They've been so low. I know the 10-year note went up by from 0.7 to 1.7 in a 3-week span about a month ago. And then government regulations, higher corporate taxes are a threat. So, but, I think we're good through the end of next year.
I'm sorry. I think and I mentioned it earlier, I think the greatest threat that could occur that I've seen in a couple cycles is what the life companies and the lenders are going to start doing. There is a lot of dry powder out there right now. I'm getting more calls than I ever had. It's a situation I always have is when I've got the money, I can't find the product. When I can find the product, I can't find the money. So there's a lot of money being pressed out there right now. And if the lenders start doing some of what they did in the early 2000s, where they're saying, you know what, let's go up to 75%, let's go up to 80%, let's go up to 90% lending. That's where there's a risk because the lenders are forcing the investors and the developers to take risk because now they're getting the returns they need to be receiving for risks they're taking, but really the risk is being held by the lenders. And that's where, when the music stops, because the music will stop, it always does. And if there's a lot of this going on and there's a lot of spec development going on out there at that same time, because there's money pressing it, that's where it gets ugly. So I think as long as the lenders stay in check, it'll force us as owners and developers to stay in check also.
You got a comment?
I just say, geopolitical risk, finance risk, and both of those, and also employment, we got to really watch because it's just affects every aspect of the supply chain. And the biggest issue that's come out of the pandemic, at least from an industrial side, that I hear every user talk about, regardless of the nature of their industry, is how their supply chain has been disrupted, whether it's getting ketchup or plastic caps. So I'd say that a supply chain risk going forward with that, we look at how much talk the Suez Canal, when that ship got stuck there, right? I mean, there's I'd be really cognizant of disruptions in the supply chain, and along with the technology and finance risk.
Yeah, I don't candidly have really much to add. I agree with everything that's been said here.
Well said.
Okay, so I think that'll wrap it up. I think we've been about 50 minutes. I think we got a little bit late start, but hopefully the rest of your program will stay on schedule, Arnie.
The non-ties won, right?
Yeah, the non-ties win.
All right, thank you, everybody.
Thank you, Ernie, Michael, and Mark Menzies.
Nice work. Yeah, thank you. Oh, great. Thanks, fellas. Yeah. I look like that guy, so a lot of guys look like me.
Okay, I'd like to call the next panel up, please. The importance of partnering with municipalities, service providers. Behind me. Nancy Roach with Strata. And I believe we have the mayor here, Village of Romeoville. Mr. Mayor, thank you. Who else do we need? Who's moderating? Are you moderating this one? No, you're not moderating. Shar, yeah. Shar, hey. Let's take our seats. Take our seats. Greg, you're blocking the camera for the virtual audience. That's one way to get him to sit down. All right, let's proceed, folks, with the last panel of the day. So again, thank you all to our sponsors, and we look forward to working with everyone now and throughout the end of the year. Thank you.
Good afternoon. Does anybody need a few minutes, or can we just plow forward here? Plow forward? Okay. So my name is Charlene Kulam. I have been in economic development 34 years. Don't judge me. We have a great panel here, and we're going to start left to right, and each of the parties will introduce themselves, tell you a little bit about themselves, and then we'll go into some questions that have been raised that we would like to address. How's that sound? Everybody get their COVID shot? Okay, so Nancy, would you like to start?
Okay, is that on? It is. Hi, I'm Nancy Roach. I'm the founder and president of Strata Real Estate Services, and I am the service provider who's on this panel today.
Hi. Hello? Yep. All right. There we go. Hi, Brian Gay, President and CEO of Invest Aurora. We are the City of Aurora's public-private economic development agency. I'm Mayor John Noak, and I think we've probably worked with a large number of you over the last decade on some project here or there. I'm Mayor of Romeoville, and also sit on a number of national, regional, and local boards, everything from CMAP to National League of Cities to U.S. Conference of Mayors. So hopefully we'll have a lovely conversation here today. And actually, I'm very excited to be with most of these panelists. I don't know about you, Greg. Just kidding. Also had the good pleasure of working with many of them over the years, and proud to not only have them, as people I've worked with, but to be able to call them friends as well. And great deal of respect for all of them. So thank you.
I don't know how to follow that up. My name's Jason Lake. I'm with Cushman Wakefield. I am a site selector and deal with incentives and taxes, formerly with Arthur Anderson back in the 90s. I've been doing it about 30 years.
Good morning, everyone. I'm Greg Budlove. I'm the president and CEO of Choose DuPage. We are the public-private partnership responsible for economic development throughout all of DuPage County.
All right. I am the oldest one here. Okay, we're going to start with a few questions. The first one, I'm actually going to direct to Nancy, and all of you are also welcome to jump in, wave or throw something at me, or you can just, everybody has a mic, correct? Okay, good. Okay. So how can service providers and subcontractors help optimize the ROI in industrial properties? That's a tough one.
I'd first also like to thank Real Estate Journals for inviting me here. I'm excited to be a part of this in-person event. It's been a long time. Just to give you a little bit of an insight, my company, Strata Real Estate Services, is still a unique company. We provide repair and maintenance services for commercial industrial properties, and we self-perform. And so to answer your question, what I've heard throughout the panels is that there's still going to be a lot of people that are going to work remotely. And what I'd like to say to everyone is that your properties don't get maintained remotely. someone has to actually fix systems, building systems. So we have been around before the pandemic, and what we have done is before the pandemic, we realized that there was a need for marrying kind of boots on the ground and technology. And so we did that. And so when we go to a property, you could be sitting at home, you could be sitting in another state, and we're going to be able to report to you what repairs have been done for your property. We can inspect them. You can get real-time information. And especially for industrial, you don't have a full staff typically sitting in an industrial building watching your properties. So we think that's a good return on investment. Thank you.
Greg, I'm going to direct this one to you. I wanted to know, well, everybody wanted to know, what are you hearing from the business community on what the main requirements are for locating or expanding in the industrial market? I know there was a panel prior that addressed a little bit.
From an economic development perspective, we work very closely with employment agencies, College of DuPage and the like. And what we're hearing right now, today, is we are recovering from the pandemic and I can't get my employees back to work. So labor, labor, labor. It was a key driver and it was a key mission of Choose DuPage pre-pandemic. We had actually built and developed an entire marketing program with international outreach centered around the theme of DuPage County is no longer your father's Oldsmobile. We don't roll up our sidewalks at 8 o'clock. We have bright, vibrant communities with lots of stuff to do. The reason we did that is because our unemployment rate at the time was hovering at around 2%. So it wasn't an employment issue. It was we needed more bodies in order to fill the need of the business community. And because we were trying to position DuPage County as a, metaphorically speaking, cooler county, a hipper county to compete in the tech market and compete with the emerging growth in IT and technology, those were the types of workers we were trying to attract. The tables have been turned. We are now simply trying to get bodies back to the places where they used to work because for many, many reasons, either they've left the region to go to work where there is other work, or they're finding it for whatever reason more advantageous to not return to work. So this is the challenge that we're facing right now. In a word, is labor.
Go ahead, John.
Yeah, I'd actually like to resonate that as well, except for, I see Doug Pryor out there too. We think we're a little hip in Will County as well. Actually, I like to think the whole Chicagoland area is pretty hip. But it is, we just did a major deal on a facility with Wayfair, and probably one of the top three things is, and maybe the top thing was access to workforce. It is, continues to be one of the number one drivers in decisions. Obviously, we got to do the math and cost structures where, some of these facilities could be other places, but our access to workforce continues to be one of the driving things, infrastructure as well, but workforce without a doubt, time and time again. And it's critical to continue to support those partners in education and retraining that are out there, our workforce development boards, our community colleges, our other higher educational institution partners, our schools, and also related to the workforce is continue to make sure that we're having adequate housing. As we try and make those equations work and have enough workforce base for these businesses. So workforce is definitely a key driver in that.
Yeah. And if I could jump in here too. So absolutely agree with both John and Greg on their points here. Certainly the first, second, third topic is always going to be workforce. That was now as is before the pandemic as well. But then we also start looking at infrastructure. I think John had mentioned infrastructure. We also have to start looking at non-traditional infrastructure. So City of Aurora, we have our own municipally owned public-private partnership that handles our broadband fiber optic network. So we have over, it's like 150 miles of fiber optic cable running through our city here, connecting to both public, private institutions and everything like that. But more and more, as we're seeing requests for information for those industrial users looking at the city and the state, a lot of that is asking about fiber optic connectivity. Also, now more than ever, I think the 2 panels ago said that, lead time on some products are 40 weeks out, for steel and precast. So time is money, anything that we can do to expedite the process there. So we have, an adaptive process to help expedite projects moving through our entitlement process, going through permitting and everything like that. So, again, it's non-traditional infrastructure and it's expedited processing.
Great. Go ahead.
From a site selection perspective, when we're looking across regions, obviously labor's already been covered, and as Brian said, it's number 1, 2, and 3. But if you look at all the reshoring going on and the manufacturing and the move to more automation, whether it be for cost savings or safety, the availability of power and all the infrastructure that supports that has been a real issue in trying to make site location decisions. One of our clients is Bastion. They're a Toyota logistics company, and they design and build all the material handling equipment that goes into a lot of these logistical firms. Everyone's waiting in line for it, and they're waiting in line for parts as well. So we've seen instances where, say, even a processor manufacturer has to go into a building and immediately, access 50% more labor than what they usually would to make up for the fact that they can't put in the equipment that they would normally put in. And then, maybe 24 months down the road, they get up to full automation. But, so that varying need of labor, it could even be higher at the beginning and tail off. And the availability of power and infrastructure to support that technology really does drive a lot of location decisions.
Thank you. The next one, Jason, I want to start with you as well. And this is probably a hot button for everybody. So I'm sure everybody would like to add a little something on this. So how important are incentives to tenant location decisions?
Hear people chuckling. We like to say in the industry, incentives don't make a bad deal or bad property good, but let's not kid ourselves. They do make the difference between site locations. And I'll give a couple examples. I'm actually going to start with something the mayor here should be very intimately familiar with. There's a e-commerce facility that will be operational sometime this summer. The mayor and their aggressiveness at understanding the changing tax landscape. We're going from retail to industrial now, e-commerce. How has Wayfair impacted how communities and states tax that kind of activity? That particular village's understanding of that and aggressiveness in pursuing that project, basically results in a $20 per square foot reduction in cost. So that's, call it 4 or 5 years of free rent, if you think about it. If it was in another location, or if, I could see that, and we actually received, offers with, other taxes involved, that number could go up to $40 a square foot in reduction. So if you start thinking about that, that's over half or the majority of a lease basically being rent free. So it makes a big difference. Then say pivot down to Indiana for an example. And my point here is that the incentives, it's not one size fits all, right? Depending upon the use, some incentives are meaningless, other ones are more meaningful depending on where you go. So we looked at, I think I mentioned before, a processor, right? We're looking at a processor in Indianapolis. They needed a lot of water. If you're inside Indianapolis Power and Light, which is the public utility down there, there's plenty of water. You get outside that, suddenly you're talking about tap-on fees of $500,000. So in this case, we are looking at sites in and outside the city. The locations also that happen to have $500,000 tap-on fees for water. Also, we're not willing to abate personal property taxes, which is, one of the things that Indiana struggles with in terms of additional costs for manufacturing or processing. So when you looked at the combined hit for every $10 million of machinery equipment, that's another $600,000 over a 10-year lease term of taxes. So between the tap-on fee and the property taxes, that put that site at $1 million disadvantage. Again, that's a couple of years worth of free rent. Go up to Wisconsin. This happens everywhere. We were looking at a 200,000 square foot build to suit. We were looking across 3 counties, probably 15 sites. And this isn't just, you know, between the extremes. We're talking 2 sites that are 15 minutes apart. There's a $5 million gap between the two when you looked at total all-in costs. That was, and because this particular client was you know, a good credit, they were going to do a synthetic lease. Okay, what that meant is the lease rate was going to be very low. Basically, what that meant is that gap represented almost 7 years on a 12-year build-to-suit lease. So believe me, in all those cases, the incentives, the overall tax structure made an absolute difference on who won and who lost.
The only, if I just would like to ask you to take that one step further, being in this type of business for over 3 decades, I've just noticed in the last 5 to 10 years, incentives have changed so much. So when you went to Romeoville and you talk about those 3 to 5 years, are you talking, or I'm sorry, it was $20 per square foot, but for how long was that incentive, and how do you make those decisions? Do you go to the village and say, I need this, this is my gap? Because that's how things used to be done in the old days. Today, they're all over the map, and I'm just
from a decision-making process, right? It depends upon the sophistication of the search, right? I will tell you what happens normally with our clients, right? They're looking across multiple geographies. This reached all the way from Aurora to Columbus, Ohio, right? So initially you may have 5 or 6 major geographies and 100 locations. You have to make an initial cut, right? You have to get down to a manageable level in order to do due diligence on those sites. There were communities near Romeoville who wouldn't talk to us. They treated us like a floor mat or doormat. All right. They didn't make the cut, right? We can't do due diligence on every single site down to the nth degree.
Right.
We got to use big picture costs to make the cut. So typically you're going to make a few cuts until you get down to a manageable size, and you're running pro formas. It's the entire operating budget. It's labor, it's real estate, it's taxes, it's everything, it's utilities. And it's a very objective way to do it. And basically you're looking at a 10-year run and a net present value. How much is it going to cost to operate there?
And from our perspective, and you know, that was a great deal that we worked on together. But comprehensively, and wait, I'm going to give my unabashed commercial here. If you have an e-commerce user, you come talk to Romeoville. Trust me, we'll do you right. We'll have a conversation. But you know, and I think we've been pretty clear about that to the industry, that you know, we're very aggressive in embracing the e-commerce sector, and it does obviously lends itself to a lot more. And it's something, you know, it's still evolving for the industry, I think, because, you know, it wasn't that many years ago that we just didn't have that point of sale to part of the equation. And, you know, the others who are up here represent communities. They do a great job. That's why they're here too. And they do an excellent job putting together deals too. And we won't mention any of those other communities because that'll get me in trouble.
I was just going to tell you, John, to be careful.
No, you know, we know your competition. But, you know, when you look at a deal, and our staff does an excellent job with us on this, and its philosophy is, you know, really everything's on the table, and you got to customize for every user. And it's looking at the total cost. And when we look at that, you know, we start with looking at, you know, not only the immediate cost, but, you know, what are the 20-year costs of the project, and what are the 20-year returns on whatever mechanisms we're using, at least 20 years, if not longer. Usually, this one I think was 15, but you know we're looking at those kind of thresholds. You know, 10 is probably the minimum we're looking at. You know what the cost differentials are. You're looking at everything from tax rates. You're talking cost of construction. You're talking, you know, in utility rates. You're talking, you know, access to water. You're talking, you know, infrastructure. You're talking, but you're looking at the total cost of all those things combined, and you got to look at it really comprehensively, and then look at, you know, what they're asking for, and does it make sense? But if you go into it as a municipality knowing that and you're open to that as a partner from the beginning, it's a lot easier to work these deals out. And we've been very aggressive and we're not shy about it, especially on the e-commerce front, manufacturing as well, where we can use those tools. And especially as land becomes more scarce in our sector, in our area, immediate area, the aggressiveness of which we can do a deal for something that brings in additional revenue that wasn't foreseen, or brings in higher paying jobs or a desired industry, we have a lot more flexibility. So, so we can be really creative with these things, and looking at the entire picture. And it's not, I mean, some people will go ahead and slant the state, but it's tough. This is a tough state. We've got to overcome. We're often, as Bush has mentioned, it's not necessarily competing against the people who are up here. It's competing against Indiana. It's competing against Wisconsin. It's competing against Iowa. When it comes down to it, it's one or two communities here in this area, or it's Columbus, or it's Kenosha, or those are who we compete with. So we have to look at what they do too. So the sophistication on the local level has to continue to expand its knowledge base in order to understand those are the markets they compete with today. And so you have to be, your approach has to be wholehearted in the way you look at these deals. So, and willingness to look at the unique operational needs of that user.
And then if I could just jump in here. So absolutely agree. And again, I think the approach of being a partner rather than acting as a municipality or acting as an economic development, seeing yourself as a true partner, working with the business is critical in most of these cases here, because, for most parts, and I've heard it a lot, in many cases, incentives a lot of times just end up being a rounding error, in the total picture of a project, unless it's meaningful and it actually has an impact on the project itself. So we take a look at it, we do look at that gap, what's the difference between Aurora to Romeoville to, somewhere in Northwest Indiana. There's not a whole lot of differences in many cases, but you have to, start up that conversation, be a partner, and a lot of times be a therapist too. It's like, yeah, I know it's Illinois. It's like, as Greg says, it's a good case, good news, bad news. You're in Aurora, but you're also, that's a good case, but you're also in Aurora, Illinois. And, that's the bad part. So, you have to you have to work with it. You have to kind of find what those pain points are. And again, craft an incentive program that's going to work for, for both the municipality, and the company itself. In some cases, a lot of times we do our work going out with retention calls. We have a business that has been in the community for 30, 40 years, and they don't know any better, but they don't know exactly who to talk to. We start that conversation, and an incentive may not necessarily be maybe dollars or, a tax incentive or anything like that, but it's simply just helping them find an opportunity to put in a stop sign, to create a crosswalk for employees that are going from one site to another. So there's a lot of those incentives that maybe are intangible or non-intangible, and just being able to work with them as a partner through that process.
If I may,
Mm-hmm.
kudos to Mayor Noak for the great work he's done in Romeoville, and Doug out in Will County, because Choose DuPage and DuPage County thinks that a strong region is good for all of us. What's good for Romeoville is good for Naperville. What's good for Joliet is good for Downers Grove. What's good for Addison is good for Chicago. And that's a big component of this. What's good for Chicago is good for the entire region. And regional growth and regional organic economic development opportunities are what's going to help our region begin to punch above its weight instead of punching below its weight. Not my term, CMAP's term, Chicago Metropolitan Agency for Planning, John, your guys' term, of punching below our weight. But I will say, and we could spend an entire panel, we could spend an entire afternoon talking about incentives from an economic development perspective. It's not easy. There's so many components of it involved at this point that, quite frankly, were never there before, from politics to financials to the world has become so much smaller, and business has become so much more portable, and money has become so much more cowardly that it's going to go where it can make more of itself. So while I agree with everything that everybody said, I would just, being a little cautionary, remind everybody of the old Elmhurst Bensonville days, when car dealerships used to bounce from one side of Grand Avenue to the other side of Grand Avenue because a mayor gave them a bigger sales tax rebate when they were on the north side of Grand Avenue versus the south side of Grand Avenue. Because businesses are really smart, and there's really smart people helping businesses make these decisions so that strong mayors and really quality economic development analysis is absolutely essential. Otherwise, it's just a race to a bottom. It's literally that simple. It's just a race to the bottom.
I disagree with the race to the bottom. Clearly there's going to be situations where we can look back and say, well, gosh, did that really make a difference? And was that really necessary? But, in terms of the notation of, how close sites are to, or regions are to each other, at the end of the day, it comes down to specific sites. It's a site that drives it. It's the developer, it's the cost basis, it's their access to capital, it's what the elevation was on that site, the money that's sunk into it. And a lot of these things layered into that is also the human construct of taxes. How does Illinois tax things and finance schools? How does Indiana do it, right? All these human constructs have already created an artificial environment, right, where some communities have an artificial advantage over others, and then you've also got the real physical things. God gave certain communities in certain places certain types of land and dirt that others don't. So at the end of the day, the communities have to be able to compete, and they have to be able to recognize what their strengths and weaknesses are and have the tools to be able to do it. Otherwise, we're asking them, we never ask a human to do this, a person that's competing for a job or a company competing for work, to just sit there and wait and see what happens based upon what they happen to be given.
And I understand Greg's point on some of this. Retail is obviously a different equation altogether. And talking again purely what we're here today on industrial. However, oftentimes, at the end of the day, the deal, again, we're not necessarily competing with communities in our area as much as we are, again, competing with locations outside of the state of Illinois. I don't know how many deals it's come down to us in mostly locations somewhere else, whether it be Columbus, Northeast Indiana, Southern Wisconsin, somewhere in Iowa, and the flexibility, and I caution everybody because there's a lot of discussion again in Springfield and other places about restrictions on, our ability to craft deals. They're not necessarily hurting us from competing, picking sites in Illinois. They're hurting us from keeping them from picking sites somewhere else, and outside of the state of Illinois. And we have to be careful about that because, when we look at these costs, and again, this, and I expect other municipalities that may not be doing this to look at those longer term costs and what the cost differentials are on if you're talking about a 650,000 square foot building, I mean, it could be tens of millions of dollars cost difference between a site in Indiana and a site in Ohio or a site in Wisconsin on construction, land, and everything else. And if the company just looks purely at their upfront costs, we're going to lose. And those projects are not going to come into the state of Illinois. And like I said, it's not too often that we're competing with other sites in Illinois so much as we're competing with sites in other states because the cost differential and the upfront cost can be dramatic. And so, and it is, we have to understand as a state, do we want our land to be devalued? No. Do we want our workers to be paid less? No. We want our construction companies to be able to make money. We want the trade people that work for these companies to be able to make money. So unless, and we don't want that to change. So we have to figure out other ways to be creative in order to keep these deals from leaving the state of Illinois because they can just, it is much easier for them, as has been said, to go somewhere else. And that includes the sectors we're talking about.
Okay, let's move on. This is it's actually a spin-off from the first question or the question that was actually just discussed. But basically, let's talk about what are the biggest factors affecting tenant industrial location decisions. Jason. Oh, you can go.
It really depends upon the sector, right? So if we're talking about, either distribution or manufacturing that has complicated, nodes of transportation, right? The first cut will often be really a transportation study. And where is it? And that will often drive you down to 3 or 4 regions within the US that are fairly comparable. So that particular item can completely eliminate entire geographies from the list. Then after that, and if it's not, then the second item is labor. For those that don't have big transportation node issues, labor is always going to be at the top. So labor is always in the top 1 or 2. With Amazon basically being everywhere, right, and Wayfair, all these companies, it doesn't matter who you are, you're not going to be able to locate where there isn't someone like that. So that has become a real challenge in terms of trying to define, what is the availability and sustainability of labor. Then after that, it comes down, to a lot of very specific needs if you're a manufacturer, whether it be power and water and those items, and the availability of buildings that have that are either coming out of the ground and can meet your delivery time if you're just in time in terms of your planning, or have the utilities to support manufacturing or whatever. But I would put them in that order, and the mix just changes a little bit depending upon the use.
Did you want to add something
No,
there?
I like the previous panels touched on it,
Right.
in speaking for DuPage, those 1 million square foot warehouses and the availability of land and whether or not you even have land big enough to accommodate them. And when you're a mature county and when your strategic planning and your historical development practices have not lent themselves to 1 million square foot warehouses and manufacturing facilities, that's another ingredient that needs to be thrown into the mix. So everything that's been said, plus just really, the availability of the land. And then as we start to see and continue to see the spread move out from the central business district in Chicago out further and further and further, the price of the land, because you get to the point where if you can find 1 million square feet in the location you want, you might not be able to afford it because the landowner is looking at the highest and best use of that property and saying, sorry, but I don't want a data center, or I don't want a deal that's going to net me $7 a square foot or whatever the case may be.
Yeah, that kind of leads to the next question too, that has been brought up and again was addressed in the previous panel, but I think it affects mostly the communities that don't have a lot of land or that are landlocked. What do you do to do business attraction and expansion when you don't have enough developable land?
I hate to go first again, but I think DuPage County may be the poster child for that question.
Right.
And I think what you do is the first thing you do is you make sure you finish the Western Access project into O'Hare Field, right? And as the previous executive director of the Tollway, who was very proud of the fact that that project got approved and got passed under my tenure while I was there, we all need, and you all should, I know you all recognize the absolute critical importance of that. I think we all know that that was originally done in conjunction with a Western terminal and the need to move more people in and out of O'Hare. Well, the pandemic kind of took care of that. But what was lost during that was what we're all here talking about today is manufacturing and freight and the movement of the goods efficiently from point A to point B, and the benefit that Western Access and the 127 square miles of opportunity immediately west of O'Hare Field, which is, other than the DuPage Business Park out in West Chicago, in DuPage County, that's about it. So from my perspective, what you do is you make sure that what infrastructure you have and what assets you have, you amplify and you complete and you deliver so that you guys all have opportunities to build and develop and infill and resell.
Well, and I think too, it's also the responsibility of the community to really understand what that community is. Are you a manufacturing hub? Are you simply a bedroom community? Are you, transportation logistics? Are you located on a train line? Are you located on an expressway? What exactly is, those key contributing factors that make you unique within the marketplace? It's like a few years ago, we had the Amazon headquarters, site search. And, a lot of people in the economic development world said, what a waste of time, hundreds of millions of dollars of consultant and municipal's time wasted to try and figure out if they could get if they could get Amazon to move to their small town. I'd actually flip it on the other side, and that it was a great opportunity for municipalities to really, measure themselves against, their neighbors and find out exactly what makes them unique. What are those things that they have to work on to actually be, successful on an attraction process, and really help them identify what makes them unique. In Aurora, we know that, as we push further west, we're not going to be seeing the large, high rises that we see here for office development. We're going to be, we're starting to see more of that transportation logistics, but we're a manufacturing community. In the last, 36 months, we've created 2,000 manufacturing jobs, not logistics and transportation, but actual manufacturing. We have those folks. We know and understand our workforce market, that they're coming into our area. And then again, if we were going out shooting for more retail or whatever it might be, we would have missed out on those opportunities, not knowing exactly what we are. So you definitely have to have, in order to be successful, to be able to attract businesses that are a right fit for your community, you have to understand first what your community is.
Okay,
Just one more follow-up point, because I think Mayor Noak has done a phenomenal job in Romeoville. Sorry, I don't mean to, make that sound like a self-promoting thing for you, but
Greg does a really good job too.
Well, I mean, the reality, here's the reality. There's two things. The reality is that the invisible hand of the global economy is bigger than any economic development person up here, and it's bigger than any site selector up here, and it's bigger than any mayor up here. And unless people recognize, and it's perfectly acceptable if you don't recognize it or you don't enable it, that, I'm happy being a bedroom I'm happy being a bedroom community, to Brian's point. Okay, that's fine. But then don't expect to have robust business growth within your community. And again, that's fine. And the reality is, in my case, again, in DuPage, when we look at that 127 square miles and you talk to people in that quarter and they say, man, I really want hotels and I really want retail and I really want this and I really want that. The reality is that guys like this are telling you what you're going to get, because that's what the market is calling for. And whether or not you're willing to embrace it as part of your strategic plan and as an elected official, your name is on the ballot, mine's not, ultimately determines to a large extent the future growth of the region. And I think there's a reckoning coming. We've spent the last 4 hours here talking about 1 million square foot warehouses. Nobody's talking about retail anymore. We spent the last 4 hours here talking about distribution, 40-foot clear. Take that to some of the bedroom communities throughout DuPage County and see what kind of reaction you get. But the reality is that it's coming. And I believe that from an economic development perspective, a big part of what we do is to educate those leaders on, if this is what you want, if you want that kind of growth, this is what's out there and this is the future. And we can either get ahead of it or watch it pass us by.
Okay, let's back up here for just a minute and look at it from a different perspective. So Nancy, I'd like to ask you what we can do, or what are some new and innovative products, technology, things that we could do to maximize the performance and productivity with a site or a location. I think that would add to some of these concerns.
Thank you. Well, from my vantage point, I should back up a little bit. And for the people who don't know me, I started in this industry managing industrial properties. So I'm very familiar with older generation, today's generation of properties, tenants, what tenants like, what they complain about, and pre-COVID, post-COVID. There are a lot of industrial properties in the Chicago market that are not 1 million square feet. They're 30, 40 years old, 20 years old. They need repairs, they need maintenance. So from a perspective of trying to help owners, they may not be able to be replacing systems. So you've got to find a partner that's going to work with you to say, what's the best approach to being cost effective for the buildings? It may be maintaining, it may be replacing, or it may be not replacing and repairing, but you've got to provide an environment for people, just like we talked about earlier. People want to be in a safe building. They want the lights to work. They want the air to work. Those days that someone on another panel talked about going into a building and being scared, those days are over with. So even if you have a building that's not brand new, realize that if you're going to attract the kind of tenants that you want, you've got to provide the environment. And again, it's all about what's the best path to take with that particular asset.
Great. Did anybody want to add anything there? Okay, good. Okay, so one of the things that we would like to tie everything together and get everyone's view on is the future. And I know everyone has their view of the future, but let's look at the hope and what's ahead for the people in the audience, what they could look forward to. The other thing that wasn't touched on that maybe we can also get to is like in my region, I don't have a scarcity of land. I have 350 acres. I have another 250 acres, but I do have that threshold where, 350 acres was also, some of those buildings were built in the 50s. So again, we have land, but then we have the price and the incentives and the labor needs and so on and so forth. But things are going good there, I'm happy to say, but still don't know what the future brings for everyone, whether you have land or you don't have land, where you have to knock down a building or maybe annex somebody's land. I don't know, but you want to take that?
Well, maybe we should talk about what we see for the future and kind of wrap it up, because I think we're about to run out of time as well.
Okay.
So we're already a little bit over our allotted time. Obviously none of us could see, nobody knew a pandemic would hit us over a year ago. I mean, so let's be honest, we don't know, have a crystal ball on the future for sure, but at least in the near term, a few things again, I want to caution everybody, there's a different environment in Springfield. This industry probably needs to continue to monitor some of the activity going on there. It's a different, different environment, so they can produce a lot of different ideas. Now, there's good to that, there's bad to that. But it means that everyone has to work a little longer or a little more harder to watch out. Also, looking at the kind of the bigger picture too, and the federal, one of the things that's probably very positive is, we're going to continue to see a lot of federal dollars for infrastructure. That's going to help a lot of municipalities to help this industry and help their residents in their traffic and a lot of other things. And the things that we've been mentioned here again today, broadband, there's going to be a lot of money for broadband, a lot of those things. But, we've probably all seen and following the trends on material costs. I do caution that, as this money comes in, there may be additional pressures on material costs for a little longer out, for 2 or 3 years, as those projects start to come into mix on things like steel and other material costs that affect the industry as well. So just things to keep in mind as that money comes in. It's kind of a good and bad all mixed up into one, but there will be opportunities there that didn't exist before. And so it's key that we maximize those opportunities, talking about CMAP and regional planning and investing in our regional infrastructure, which is really key to our success. Workforce is key, regional infrastructure is key. We have to keep investing in it. The good part is there's going to be some funding, but it's important that we properly plan that and invest that properly as we go forward. And I think just again, I want to thank everybody for having us here today and being a part of this once again.
Why don't we give everybody a chance to answer that? You want to go? Right.
Ditto everything Mayor
Okay.
Noak said, as well as I think I maybe define manufacturing a little bit differently than the broad definition that's been used here today. I think a lot of what we're talking about manufacturing is really more warehousing and distribution and logistics, as opposed to physically making something. A good old fashioned, the guy from Indiana said he had 6 OEMs, 5 of them were in the auto industry. But that's fine. You call it manufacturing, call it whatever you will. Obviously, from an economic development perspective, manufacturing on the upside for the next year to 2 years. Thank goodness, because I don't think there's going to be an office building built in the suburbs in the next 10 years unless it's a spec building. I'm sorry, not a spec building, a build-to-suit building that a business owner with a giant ego wants his or her name on the building. I truly don't see any office buildings being built. And I see a lot of trampoline parks in our future that once used to be retail big boxes.
Jason.
Have more options of places to take my kids, burn up the weekend. Yeah, it's, you know, from a short-term perspective with the construction prices going up, and it's not just the cost, it's the availability and what does that do to your planned timeline to be operational. I envision and I hope that there'll be more second looks at maybe properties that existing infill properties, existing properties that aren't the cat's meow, right? Maybe designing around those, and that may give, you know, to that earlier question of, you know, what do you do if you don't have land or you've got a lot of existing buildings out there? Maybe that gives them a little bit of you know, support. Long term, you know, what does technology do? We all recognize and easily see things like it takes less people to build something than it used to, right? With automation. At the same time, look at, you know, parking per square foot, right? Where we've basically doubled it in the last less than a decade. And to the point of land, you know, when you put up 1 million square footer and you need a parking space and a half to support it, that's an enormous amount of land. You know, will technology, you know, are we going to have to put cars on roofs where we're going to have to put structured parking next to these things? And or will automation, you know, car sharing and things like that take pressure off? What is that balance? Do you put a lot of money into, you know, structured parking, et cetera, in the immediate term to meet those needs? And then 5 or 10 years from now, maybe the need isn't there and you've got all this extra space and capital you've dumped in that people no longer need.
Brian.
Again, I think the topic of this, you know, I'd really like to just end kind of touching on the topic of this panel here, and that it's working with your municipalities and your local economic development professionals. You know, too many times economic development professionals in the development and permitting department have to be reactive to trends in the marketplace. And that's not just because we're not trying, it's just that, you know, our planners are focused on planning, and things that are coming out change so quickly, whether it's technology, you know, it's going to be electric charging stations here going through, you know, it's like out of our 16 business parks in Aurora, I think we have a total of 30 electric charging stations out of all that space. And you're talking about, you know, tens of millions of square feet of industrial. So, you know, those type of things, helping us see around corners, working with your elected officials, with your planning departments, economic development professionals, allowing us to kind of understand what you understand is going to be important. And I do see, you know, in terms of a forecast, you know, I do see a lot of infill development happening. I think that we talked about it a little bit earlier on one of the other panels, talking about taking up and looking and having a willingness to look at hairy deals. I think that's going to be, you know, a trend here going forward. So it's going to be fun. It's going to be a very active 3 years.
I'm trying to remember exactly what the question was, but if it's
The future.
The future, I think, yes, technology is going to be a big driver. I think we need to be smart with the technology and utilize the technology in the best way for our assets.
So do we want to open it up for questions? We have any questions? Go ahead.
That's correct. Two different approaches. During the pandemic, everybody was working, so unemployment was low. So when a company needed workers, there was nobody around because everybody was already working. Now, furloughs, people migrate, people go to places where there's jobs. Those employers are trying to bring people back. The people are gone.
from my vantage point, even pre-COVID, finding, finding the correct people who have the backgrounds to do repair and maintenance is very difficult. And I think anybody in the industrial industry knows that finding talent in those areas is very difficult.
Anyone else? Thank you.
We're going to get a quick photo of the panel so that we can promote Illinois rules. Okay, thanks again, everyone, for joining us. Appreciate it. Thanks again to our sponsors. We will be in touch with you throughout the year. Stay well, stay safe. May 18th, we have 3 sponsors available.